sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. You know, they are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, you know, as desperation increases in the market and trading volumes go up. Now, at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to 700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world. And when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided.
The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year.
1, 2,
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in the story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so. And came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure that different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright brothers airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe.
On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's done super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $7 to $9 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way to the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we need it, you know, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world?
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big, big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick. It's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Choppy session, an update right now. On track, though, for a big losing week in the range of 5%. We've got the S&P up by 21 points now, higher by about 0.6%. Dow Jones Industrial Average back above 30,000. Barely 30,000 and a decimal, up 77 points right now, up by 0.3%. NASDAQ up 192, higher by 1.8%. 10-year yield 3.22%. Spot gold down $20 the ounce to $18.37, down 1.1%. West Texas Intermediate crude oil down $9 a barrel now at 108.41. That is a drop of 7.9%. Stocks so higher after struggling to find direction as traders parse comments from Fed officials reiterating that the central bank needs to do more to curb the hottest inflation in 40 years. Christina Hooper is Chief Global Market Strategist at Invesco Advisors, and she says right now it's all about the data in trying to figure out the Fed's thinking.
We know the Fed wants to front-load rate hikes, but they're also clear they are very data-dependent. We just saw an enormous pivot over the course of a few days. The Fed had anticipated raising rates about 50 basis points until they got CPI and inflation expectations last Friday and made the decision to do 75 basis points. So we want to follow that too because there is no set path.
A gauge of future economic growth is flashing a warning. The index of leading economic indicators dropped in May for the fourth month in 5. Oil down the most in 5 weeks as Fed Chair Jay Powell reiterates his will to curb the hottest inflation in decades. Oil stocks tumbling. ExxonMobil down 5.5%. BP's ADRs down 6.1%. Chevron down 5.8%. EOG Resources down 7%. Pioneer down 7.6%. That's a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
And a very good afternoon, everyone. We are live in our Bloomberg Interactive Brokers studio. We are streaming on YouTube. We are not in Grapevine, Texas anymore, although we almost stayed another day.
Hey, if you didn't hear Paul Sweeney on the radio this morning, that's because he got stuck in Texas. He's trying to make his way back.
I think he's just playing in the water park.
He's not. I emailed him.
I know. I heard.
Yeah, his flight was canceled.
He couldn't get any flights.
Nothing.
All right, we're going to talk about the airline situation because Tim and I both came home at 2 in the morning Friday time, so we got lots to cover. First up, though, what to do, where to go, stocks struggling for direction, investors really fretting over Fed action that could potentially, likely, I don't know, will it happen, tip the U.S. economy into a recession.
I mean, look no further than what oil stocks are doing today.
Your face said so much. You're like, yeah.
I mean, look at oil stocks. That's what traders are thinking. We're going to talk about that in just a minute. On the big issues that companies are dealing with, supply chains, inflation, uncertainty, and economic outlooks. I spoke with Scott Baxter, the CEO of Contour Brands. It's the company behind Lee and Wrangler jeans. Got some good info on. He's really optimistic, by the way.
We all wore Wrangler as a kid. Did you?
Yeah, I did. Big Texas, California, big markets for the company.
All right, we're going to get into that. We've got the latest on the January 6th hearings. We've got the president and CEO of 23andMe Holding. And then we've got some of our most read on the Bloomberg today.
Yeah, Jerry Smith is going to join us to talk about Chris Licht, the new CNN boss who's seeking to create a less divisive news network, and also some ideas on how to bring up that revenue.
Cabin Fever, a new book is out. We've got an excerpt. Yeah, not good stuff at all. And then we've got another author with us. Her book, Build the Damn Thing, How to Start a Successful Business If You're Not a Rich White Guy. I love that title.
It's a good one.
All right, let's get to it, and let's get to the Market Drivers Report. And let's set the Business Week agenda on this Friday. So much to talk about in what has been a crazy busy macro market week. Kriti Gupta, markets correspondent at Bloomberg, right here in our Interactive Broker studio. Abigail Doolittle at Bloomberg headquarters here in New York City. On the phone, our markets reporter at Bloomberg News. Kriti, let's kick it off with you. So today feels like I'm exhausted. It's Friday. Let's take a long weekend, everybody. Yes and no. Yes, in that I think we are all exhausted. We're all ready for this long weekend. But the stock market, I think, is dealing with a lot of different factors. I mean, look at it. It's triple witching day, which means that a lot of that options expiration is happening today.
You knew that, Tim. You were talking about it right over that cocktail we had yesterday in our triple delay.
Well, it's triple witching day. That just means that a lot of people are going to kind of use today to roll over their contracts. You also have the fact that it's going to be a long weekend, and 3 days of potential risks. And does anyone really want to go long into the weekend? That's going to be a major question. But also, I mean,
but not massive selling ahead of the weekend either.
Well, it's still 2 hours till the close. We don't know, because in the span of, I think, 4 or 5 hours that we've been trading here, you've already seen the S&P 500 dip into the negative twice already and be in positive territory 3 times. So
want to make a bet?
It's coming
Who wants
back.
to make a bet?
I'm thinking it's going to close higher.
I
I'll
am
bet you.
too.
Oh,
I
you
am
are?
too.
Okay. Creedy's taking the under on that.
All right. All right, Abigail Doolittle, where would you place the bet here?
I think what's catching my eye the most right now, not that I would necessarily make a bet on it.
I knew it, you wouldn't.
Oil plunging.
I was going to ask you about that, Abby. I'm so glad you're bringing that up.
Yeah, it really stands out. It's down 10%. I think it has something to do with the dollar being higher today and also on the week. It's interesting. Oil down about 10% on the week, the worst week since April 2020. The Bloomberg Commodity Index headed to its worst week since March of 2020. So not so long ago, the S&P 500 had been headed to that benchmark, but because of today's little bit of buying action, and agreed, it could go any way. I think if I did have to bet on stocks at the end of the day, I would bet for a rally. I think that investors are gunning for some kind of a risk rally at this point, and still sort of in delayed reaction to some of the commentary out of the Fed meeting. But yeah, oil is really interesting, because if that drops back down to 100, technically it looks like it should. That could be a little bit of a tailwind for stocks.
Okay, Mike McKee is just like laughing all the way home right now, because he called this earlier this week, senior commodity strategist here at Bloomberg Intelligence.
Oh, Mike McGlone?
Mike McGlone, excuse me, not Mike McKee. Thank you.
Mike might have been laughing too.
Mike McGlone, yes. Thank you so much for that, Carol. I'm tired.
Hey, 3 hours of sleep. This is
right?
what, folks, we're warning you. A few hours of sleep. I can't even tell you what you're going to get out of Tim and me today.
Creedy, I want to get your take on energy too, because I know this is a sector that you watch really closely.
Yeah.
Down in the S&P 500, 5.7%. Abigail talked about dollar strength, but I'm also wondering recessionary concerns too?
Yeah, no, it's going to be both, really.
Okay.
I mean, and if I can just kind of walk through the ripple effects here, because I think the way to look at this market right now is kind of like a stack of dominoes, really. I mean, overnight you saw a lot of moves coming out of, or lack thereof, I should say, but a lot of volatility coming out of the BOJ. So you did have these massive moves in the Japanese yen, in the euro, in the pound. And what that all does is just makes the dollar stronger and stronger when you have all these other currencies weakening. And so you kind of had, right off the bat in today's trading session, stronger dollar was the story. To see it kind of, as that move accelerated, to see oil prices kind of turn around, that I think is pretty significant. But it's not just oil, it's copper, it's gold, and that's really where, when you see the entire commodity complex drop, that's where you know that it's a dollar move, because a lot of these contracts are at the end of the day priced in dollars. But to your point, I think this is also recession talk, because remember, we did hear from Chairman Powell today, and he said very bluntly that 2% inflation target, they're gonna really focus on it. They're gonna do. I don't think they used the phrase whatever it takes, but it was something along those lines. And I think that's really scary. They're saying that basically recession, it's not a deal breaker in taming inflation, and ultimately that means lower demand. Therefore, that means lower commodity prices.
Larry Summers talking about we're going to need to see the employment rate up to like 6% or so. Abigail, come on back in terms of what you're going to be watching in terms of the trade next week after what a wild week this week.
One thing I'll really be watching quite a bit is Bitcoin, and I'm not a Bitcoin person.
You should see Tim. You have made his day.
So happy.
So I'm not a Bitcoin person at all. Right now, it seems to be stabilizing a little bit. It's down just 0.5% at a little bit above $20,000 Bitcoin. But the reason I think it's really important, everybody's talking about wanting to see stock capitulation. The Bitcoin chart earlier this week had been looking a lot like there were signs of capitulation. On a long-term basis, it still looks that way. But to prove that, you need that massive buying on the other side. So if we see some kind of massive uptick for Bitcoin next week, I would see that as some kind of confirmation of some sort of near-term move into risk on. And the other thing I would say is, yeah, at some point I think that it will be a little bit more than a bounce. It will be really tricky for investors. It could be a number of weeks, even a month or two, and really suck people in and then swish them out.
We're looking for those, capitulation indicators. Kriti Gupta, markets correspondent at Bloomberg. Abigail Doolittle, markets reporter at Bloomberg News. Guys, have a good long weekend.
Let's get a check on latest world and national news. Denise Pellegrini standing by in the newsroom. Hey, Denise.
Well, speaking of Bitcoin, it's slightly lower, down about 0.5% today. Babel Finance is freezing withdrawals. It's the second major digital asset lender this week to freeze withdrawals, causing more panic. Doses of COVID vaccines for kids under 5 could go out Monday. FDA Commissioner Dr. Robert Califf says parents are needing to get the kids a vaccine because of the high risk of hospitalization from Omicron.
Since the surge of the Omicron variant, children 0 to 4 years of age have been hospitalized at a rate approximately 5 times higher than the previous peak experienced during Delta variant predominance.
And Califf says final CDC approval of the vaccine for kids is pending. President Biden blaming oil companies for sky-high gas prices, blaming corporations for having drill leases they're not acting on.
Should not be decided to make an exorbitant profit.
And Biden commenting there on his way to Delaware. New energy pressure on Russia will be on the agenda at the Group of 7 in Europe this month. Nathan Hager has more on that.
A price cap on Russian energy imports is likely to be on the table when G7 leaders meet in the Bavarian Alps June 26th through the 28th. Sources tell Bloomberg News lead negotiators for the member states have been exploring the mechanism as part of their preparations for the gathering. The idea has been championed by Italian Prime Minister Mario Draghi, but other members are resisting it for fear it could distort markets or risk retaliation. Russia did cut supplies to Italy, Germany, and France this week as their leaders visited Ukrainian President Volodymyr Zelensky in Kyiv. In Washington, I'm Nathan Hager, Bloomberg Radio.
All right, thank you, Nathan. Global news 24 hours a day. I'm Denise Pellegrini, and this is Bloomberg.
All right, Denise, thank you so much. Carol Massar, along with Tim Stenovic, TGIF, everyone.
Yeah, Carol. We're there.
You're feeling it.
I'm feeling it.
All right, so let's get to this story. We're going to talk a bit about the January 6th hearings this week. Meantime, we've got a story on the Bloomberg. YouTube removing a video clip of part of the U.S. congressional hearings over the January 6th riots because it contained comments from former President Donald Trump that the company considered to be misinformation that violated its policy on election integrity. This is interesting because if they're trying to present a case and make a case for false information that was put out by the former president, and that stuff goes up.
But
what's the responsibility?
It violated the company's policy. So there seems to be some sort of disconnect here because there is I think anyone would argue there is the newsworthy element of this too, right, Carol?
Exactly. How often do you sometimes show something to say, okay, this is not correct, this is wrong? We do it all the time.
Yeah, you do it. And the thing is when we do it as journalists, we point out that it's not true.
Exactly.
And that's where I think these platforms are running into a sticky situation. So here's what's going on.
Is it sticky or is it just not? Come on. Sorry. All right, go ahead. You go.
I don't run YouTube. Do you?
No.
Okay.
No.
So the House Select Committee has been investigating the Capitol riots in a series of televised hearings that have also been uploaded through YouTube to the committee's official website. This excerpt in question contained testimony of former U.S. Attorney General Bill Barr, but also a clip of Trump promoting lies about the election on the Fox Business News channel. This, according to the New York Times.
Yeah. So it's interesting. YouTube, of course, owned by Alphabet's Google, does not or does permit content with false claims about the election in some instances, but only there is additional context, such as countervailing views in the video's description.
It's sticky because it's difficult to know, first of all, to be able to police this stuff.
I'm just going to say, when I used to start out in journalism, you would do a story and you would get different perspectives. You were very careful about your sources, but you presented them as
Yeah, but who won the 2020 election is not a perspective.
No.
Nobody seriously thinks what Donald Trump thinks.
So come on, people.
There's no serious person.
Come on, people.
Yeah.
Get real. I don't know. This is tough. I mean, people get so much of their news from social media, so we have to kind of figure this out. And so it's clear. This is Bloomberg.
Connection lost.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Tech shares are rebounding. S&P 500 index very close to session highs. S&P up 30 points right now, up 0.8%. The Dow up 161, up 0.6%. And NASDAQ up 215, up by 2%. Tech companies leading the way higher as traders parse comments from Fed officials reiterating that the central bank needs to do more to curb the hottest inflation in 40 years. 10-year yield 3.22%. Spot gold down $18 the ounce, down now by 1% to $18.39. West Texas Intermediate crude is plunging 7.3%, $109.02 a barrel. Bankruptcy judge David Jones says he will allow Revlon to tap $375 million in new financing. Revlon shares surging now by 120%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie. Thank you so much. Carol Massler, Tim Stanovic. We are live in our Bloomberg Interactive Broker studio, streaming on YouTube. So her company, you might recall a Business Week cover story back in November about how 23andMe wants to use its customers' genetic data to beat cancer. It was a fascinating story when we think about innovation, disruption when it comes to treatments, especially when it comes to cancer.
We've got with us Ann Wojcicki, the co-founder and CEO of 23andMe. Ann joins us this afternoon via Zoom from Los Gatos, California. Ann, how are you?
I'm good. How are you?
We're doing well, thanks. It's really good to have you with us. I want to get into everything that you're understanding when it comes to COVID and long COVID via 23andMe. But first, I want to just get your thoughts on what we're seeing with the macro environment, with the volatility in the stock market. We should note, year to date, shares of 23andMe down about 62%. Give us your take.
Oh, well, that's a big question. I mean, look, the markets are definitely complicated right now. And I think that, it's as coming from the Wall Street world and now being the CEO of a publicly traded, it is, it's interesting that, 23andMe continues to execute. I'm incredibly proud of the team. We continue to move programs through the pipeline, make drug discovery, continue to, engage our customers on, genomic medicine and where we can go with that. We recently acquired a company called Lemonade, so it gives us the ability to offer care to our customers, both through pharmacy as well as through access to care providers. So the company has just continued to execute, but obviously market conditions are challenging. So we're very mindful of the fact that market conditions have changed, and the future is more uncertain. So we take all that into consideration now.
And we want to talk too more about what you're doing, because I feel like we just came back from a conference. It was all about the financial world. I was involved in a panel that's specifically about what the future of money is, reimagining it. And I think when it comes to things like financial services and certainly healthcare, it does feel like we're on the cusp of doing things so different, especially when it comes to treatment modalities. Having said that, I just want to go back to the market environment, because we're asking all of our leaders this. I mean, when you do have a stock that is down more than 60%, I mean, what kind of pressure does that put on you and your team who are working on things that are going to take some time?
Yeah, I was investing back in sort of when the market crashed back in 2001, and it took a long time to recover. And I think that the way we approach this is really about making sure that we're doing things that are going to, see value in the near term, and probably have to minimize some of the projects that are going to focus on some of the longer term initiatives, but really focus on priorities and also making sure that you're using cash in the wisest way. So all kinds of things that we start to reevaluate, but it's really about making sure that we have a very strong cash balance sheet right now, and making sure that we extend that runway as long as possible, and making sure that all the programs that we're focused on are really essential.
Anne, I want to get to the research that you've recently found at 23andMe. Some really interesting stuff when it comes to long COVID. And I think, we're at the point in the pandemic where, Carol and I traveling yesterday, at some points I felt like I was the only one wearing a mask on some of those flights in the airport, and even at this conference that we were at. But long COVID.
I did have my mask on back and forth.
You did? Oh,
I did.
Carol did too, yeah.
But we were
It was
it.
Yeah, that was it.
Yeah.
We were in Texas, to be fair. But I do want to know, Anne, what you found when it comes to long COVID, because that's something that I think about a lot, and one of the reasons why I don't want to get COVID.
Yeah, 100%. So there's a couple things that are really interesting for me about this. So first and foremost, the way part of what we conceptualized when we started 23andMe, and it goes back to some of your earlier questions, was really a whole new way of doing research. Like, how is it that you can have millions and millions of people engaged on a single platform with phenotypic data, with their genetic information, and be able to go back to them very quickly, easily, ask more questions and make insights? And so this long COVID research that we've done is really a good example of how the 23 model works, that we could put out a survey to our customers, collect a lot of information, and make really interesting and meaningful findings. So a couple things here that are interesting, and again, being female, it's obviously top of my mind. Over 78% of those diagnosed with long COVID were women. So clearly disproportionately impacting women. People with diagnosed depression and anxiety are more than twice as likely to have it, so twice increasing their risk. Half of those people are, having persistent symptoms for over 6 months, and about 10% are having it for over a year. So it's, all this data comes from about 100,000 customers who reported that they had COVID, over 26,000 that said that they had long COVID. So we have a lot of data here, and it's definitely concerning that it's, again, impacts so many women. Anxiety being a risk factor is obviously quite interesting to follow up further on, and the fact that it's so persistent. So similar to you and what you just said, I was recently at Legoland and nobody was wearing a mask but me, and I'm sticking to my mask. I'm quite fond of my,
At the airport yesterday, Carol, I wear this duck mask around Anne and all our listeners, and this guy at the airport was like, "What is that mask?" And I had to explain, this thing's actually pretty comfortable. It's an N95.
Go ahead, Anne.
I love it. No, I think it's just clear that there's, there's clear like long-term impacts here. And so understanding it, there's a lot more to be followed up on with respect to long COVID.
We kept saying at Milken, when we were at the Milken Institute in April, nobody had masks on. And what is it, the head of Mayo Clinic comes up and
who's
he's
an
like,
MD?
Who's an MD? And he was the only one having a mask. And he kept it on to the interview, took it off for the interview, and then put it right back on. He's like, why wouldn't I wear a mask
we're in
at
good
this
company.
point? So much more to talk. Please come back soon. We love to hear about the work you're doing because I think it's so relevant to where we are going in the world. Ann Wojcicki, she's co-founder, chief executive officer, 23andMe, via Zoom from Los Gatos, California. I did have my mask on. I do like to wear it on the plane too because it keeps me warm. And then there was somebody like coughing like crazy, and I was like, yeah, I'm putting it on.
When I was hanging out by the pool, I wasn't wearing it.
No, you weren't.
I don't wear it outside.
Can I tell you, he looks so California. I wish I had taken a picture. All right, lots more to come right here on Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening to Bloomberg Business Week. Carol Masser along with Tim Stanovic. Some headlines just crossing. The January 6th panel says it's cooperating with the Justice Department and saying it will not be an obstacle to the Justice Department. They, too, are doing their own investigation.
Yeah, we're going to talk all about this in just a few minutes with Mike Dorning, Washington correspondent for Bloomberg News. First, though, let's get an update on the markets as we get close to 90 minutes of the close of equity trading. Here's Charlie Pellet.
Hi, thank you very much, Tim Stanovic. The Dow, the S&P, NASDAQ holding on to gains right now. Choppy session, though. Tech companies leading the way higher after yesterday's rout. Let's begin now with the NASDAQ 100 index up 1.6%. The NASDAQ Composite Index up 1.8%. NASDAQ up 191 points. The broader market, S&P 500 up now by 22 points, up 0.6%. The Dow up 102, higher by 0.3%. 10 years down 8/30 seconds. 10-year yield 3.22%. Spot gold down $18 the ounce to $18.39, drop there of 1%. And West Texas Intermediate crude down 6.9%, down $8.11 a barrel to $109.39 on WTI. Stocks are being led higher by gains in technology companies as traders parse comments from Fed officials, reiterating that the central bank has to do more to curb the hottest inflation in 40 years. Victoria Fernandez is chief market strategist at Crossmark Global Investments. She says she is not looking for a recession.
When we look at household balance sheets, I know we have gas prices going higher, and that's taken a big hit, and food prices higher. But when you look and kind of split up household balance sheets, higher wage earners are doing pretty well. They respond more to household wealth than they do commodity prices or food prices. They're still strong. Corporate balance sheets are still good. We haven't seen those earnings expectations come in yet.
And speaking of earnings, on a day when tech stocks are rallying, Adobe has reduced its annual revenue forecast, saying its business will be affected by currency fluctuations, seasonal shifts in demand, and the decision to end sales in Russia and Belarus after the invasion of Ukraine. Adobe shares down now by 0.1%. Recapping, 10-year yield 3.22%. Crude oil, West Texas Intermediate down 6.9%. S&P up 0.5. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So big week on so many fronts, a lot of macro issues, the Fed meeting, we're watching the financial markets, and of course we're watching, Tim, those ongoing January 6th hearings.
Yeah, let's go now to Mike Dorning, the Washington correspondent for Bloomberg News. He joins us on the phone from Washington, D.C. Mike, it's really good to have you with us. I want to talk about your most recent reporting, specifically about how President Trump pressured Mike Pence, that being the focus of the hearings as they resume. Bring us up to date on what the latest is.
Well, yesterday's hearing was kind of a riveting drama of how close Mike Pence came. There was crowds rioters within 40 feet of him as they were trying to whisk him through back stairwells and corridors to get down into a secure location. And they had informants who were in the Proud Boys who did say they would have killed Pence if they had got him. And he spent, 5 hours in this secure location in a garage on the Capitol complex. And at one point, the Secret Service was trying to tell him to get in an armored car, and he was saying no, he didn't want to do that because they might leave if they were under attack, and he didn't want to leave the Capitol. So it was really riveting.
Yeah, it's absolutely chilling to hear. Mike, I've got a question. Why is not every single Democrat and every single Republican united on just how scary this was and how close they actually came to the vice president then? I mean, if you were to take the comments of many Republicans over the last few months, a lot of them are trying to say that this actually wasn't that big of a deal.
Well, that's definitely been sort of the theme in the Republican primaries. And, there is a very large segment of the Republican Party that either doesn't want this investigated or believes that this was primarily, there was some polling up in Massachusetts that was done by the University of Massachusetts, national polling, that found More than half of Republicans thought or said that Biden or the Democrats or Antifa were behind the riots, and another quarter said it was primarily the Capitol Police. So you have these sort of conspiracy theories floating around, and you have a populist wing of the party which is dominant, where Donald Trump is the dominant figure still, and Trump has made this a test for any Republican who wants his support, that he cannot be for investigating January 6th.
You know, it's pretty remarkable when you have a vice president who's basically in hiding in all of this, and probably rightfully so, considering the pressures on him. But I do wonder, Mike, and I think about this as these hearings play out. You know, the Nixon hearings back in the 70s, people were glued to their TV sets watching this, and it really resonated with the American public. What about this, or what about maybe what was going on for the vice president at that time might resonate with the American public, if at all?
Well, I think this has the potential to break through. It's harder. I mean, back then there were like 80 million people often watching it every day, and these hearings went on, all summer long. So it was something that the whole country was watching, people were talking about every day. Well, there's nothing really that excites Americans that much, and you can't really have that roadblock coverage where, there's nothing to watch on television except this. So instead, what they seem to have done is sort of boiled them down into a 6-part limited series like you might watch on Netflix or HBO or Apple TV, where, it's important to get the most bang for the buck that they put into producing those series and try to maintain interest over a month. The other thing is what's very important in America now for moving public opinion are sort of memes, video snippets, thoughts. So you could see, especially in the first hearing, they were concentrating on creating a few of those. Like, right. For instance, Ivanka saying she didn't believe there was fraud.
It's pretty incredible here. I want to go back to the headlines that Carol shared a little earlier about the panel in the Justice Department. Just in the last minute that we have with you, what are potential legal implications for President Trump here?
Well, potentially, these could say, hey, he might have been guilty of a crime of corruptly trying to obstruct an official proceeding. It's unclear whether they'll present enough evidence that the Justice Department thinks it's worth going against a former president of the United States to try to prove that in court and win a conviction. But you can clearly tell that the committee is trying to, and may succeed in, putting pressure on the Justice Department to either prosecute Trump or maybe prosecute some people who are closer into him who were very deeply involved in this.
Mike, 5 seconds. What matters most to the American public, inflation or these January 6 hearings?
Inflation to most of the American public. You feel it every day.
All right. So glad we got some time with you. So appreciate it. Mike Dorning is Washington correspondent at Bloomberg News, joining us on the phone from Washington, D.C. I just think about this and what this means politically, right?
Not good news for Democrats heading into November.
All right. Let's get a check on world and national news. For that, it's over to Denise Pellegrini in the Bloomberg Newsroom. Hey, Denise.
Hey, Carol. Thank you. And YouTube has just removed a video clip of parts of that congressional hearing over the January 6 riots you were just talking about. And YouTube says this clip contained comments from former President Donald Trump that the company considers to be misinformation that violate YouTube's policy on election integrity. President Biden today accusing Russia of sparking a global food crisis.
With Russia's war driving up inflation worldwide, threatening vulnerable countries with severe food shortages, we have to work together to mitigate the immediate fallout of this crisis.
And Biden commenting in his virtual address to the Major Economies Forum on Energy and Climate. The FDA has just authorized emergency use of the Pfizer and Moderna vaccines for kids as young as 6 months, finding them both safe and effective. Dr. Robert Califf is FDA commissioner.
These authorizations will be further discussed by the Centers for Disease Control and Prevention's Advisory Committee on Immunization Practices.
And if the CDC gives the final thumbs up, the White House estimates the shots could be administered as early as next Tuesday. Hours after FDA Commissioner Dr. Califf, who you just heard there, was grilled by senators about the response to the infant formula shortage, White House Press Secretary Karine Jean-Pierre was asked by reporters whether President Biden still has confidence in him for the job.
Yes, yes, and yes. So the FDA has an important mission, right, is to make sure that the infant formula on the shelf isn't just available, but also that it's safe.
And that was White House Press Secretary Karine Jean-Pierre there. Global News, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. In the newsroom, I'm Denise Pellegrini, and this is Bloomberg.
All right, Denise, thank you so much. Carol Master, along with Tim Stanovic, live in our Bloomberg Interactive Broker studio. Got nothing to say about what we're going to talk about right now.
Yeah, we're talking about flying. Okay, so anecdotally, Carol and I can say that flying is terrible in the last couple of days.
Yeah,
that's how it was
fact.
for us.
Not opinion.
Yeah,
it's a fact.
that was a fact.
Yeah.
But it was an anecdote. And now
Yes.
we got a great story to back us up here for
one?
anyone who hasn't experienced it. This is about airline staff shortages threatening to ruin summer travel plans.
Yeah, airline and airport executives spent the past 2 years trying to convince everyone, all right, it's safe to fly during the pandemic. They talked about reduced touch points, hospital-grade filters. Little did they know how overwhelmed that they would be once travel came roaring back. I will say, having been in a lot of planes and airports with you, with all our business travel.
We only travel together. To anywhere we go.
That's where we go right now. There's a lot of people flying, a lot of families flying.
Yeah, and nobody's having fun here. Okay, and it's not just the United States. From Sydney, where passengers are waiting for hours to check in, to chaotic scenes in India and Europe, where the UK has seen weeks of disruption, and Deutsche Lufthansa canceling hundreds of flights. The aviation industry doesn't have nearly enough people to run operations smoothly, even as post-summer demand for travel is still unclear. Carol, it's not just the airlines, it's the airports as well. You should have seen the lines yesterday.
Yeah.
Everything felt like it was bursting at the seams.
And what's crazy, it was delay after delay, delay after delay coming out of Dallas. And then, like, you got to the airport and everything was shut down because the food was sold out.
Talk about the cots you saw in Newark.
Oh, man. Coming into Newark at 2 a.m. in the morning, Friday morning. Yes, I'm looking for sympathy. But it was amazing. There were cots, actual cots that for people who were sleeping under stairwells, looking for places that were quiet and dark. And you called them FEMA cots on our call because that's what it looked like.
Well, when I got to LaGuardia at 2 a.m., it was just people lying down on the floor and couches and benches to try to sleep because obviously their flights had been delayed. My friend drove, I thought she drove from Chicago all the way to New York. I found out she drove from Chicago to Pittsburgh to try to get home. She was able to snag a flight in Pittsburgh and she made it back.
And what was it? Was it Gatwick in the UK? Is that the one that's limiting the amount of flights?
I don't know.
It's either Gatwick or...
Luton.
Yeah, it's Gatwick.
Okay.
But they're going to limit the amount of flights that they will have this summer. I think around 800 or so, down from more than 900 typically. Oh, it's going to be tough, guys. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Techs are rebounding. The S&P close to session highs. The Dow back above 30,000, up by 136 points now on the Dow, up 0.5%. S&P up 27, up 0.8. NASDAQ up 203, up 1.9%. 10-year's down 9/32. 10-year yield 3.23%. Spot gold tumbling $18 the ounce to $18.39, down 1%. West Texas Intermediate crude plunging 7%, 109.30 for a barrel of WTI. Tech shares leading the way higher as traders parse comments from Fed officials reiterating that the central bank needs to do more to curb the hottest inflation in 40 years. Among some of those tech names, shares of Meta Platforms up 2.1%, Apple up 1.5%, Amazon up 2.3%, Netflix up 2%, and Alphabet, parent of Google, up by 1.9%. Recapping 10-year yield 3.23%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. Watching us on YouTube, Carol Massar along with Tim Stanovic. So this story is among the most read on the Bloomberg today. It's also on the Bloomberg Big Take. It is an excerpt from a new book that's also featured in the new issue of Bloomberg Business Week, which is out on newsstands. You can find it online at Bloomberg.com/businessweek and on the Bloomberg terminal.
It is riveting. I read it in this week's issue of Bloomberg Business Week. The story by Michael Smith and Jonathan Franklin, it's an excerpt from the new book Cabin Fever, and it describes the panic and despair aboard Holland America's MS Zandam as COVID ripped through passengers and crew. Michael Smith is projects and investigations reporter for Bloomberg Business Week. He joins us via Zoom from Miami. Joel Weber is the editor of Bloomberg Business Week. He joins us on the Access line from Brooklyn. Joel, I got to tell you, reading this, I felt like I was on the ship, and there's no other way to put that. It brought me back 2 years ago, and just the terror and horror these passengers felt.
Oh man, those early days of the pandemic,
wow.
and it so associates with the story of the cruise industry, and Carnival, and especially the MS Zandam. And you know, this book, which we're so proud of Mike about, Cabin Fever, really began with a Business Week story. But when we got to do the excerpt, we wanted him to revisit it and come up with something special. So Mike, tell us about the book and also the excerpt.
Yeah, like you said, it started with basically covering this story. I was just fascinated by and horrified by it as it unfolded, in the news and on our screens, and then it turned into the excellent feature story we did for Business Week. And that basically led to my friend Jonathan Franklin, who I've known for a long time. His agent called me up when he saw the story, and he said, "You have to write a book about this. It's just an amazing story. It's COVID, but it's also sort of a story of human survival on the high seas, and it's filmic and all this stuff." So he kind of convinced me to go for it. And luckily, I had Bloomberg behind me, and they really accommodated me, starting with Joel Weber. It started with that, and I just found it to be sort of a way to tell the story of what we all went through with COVID, but just to the extreme, because that's exactly what it was. This particular ship left South America on March 8th, 2020. And about 45 minutes before it left port in Buenos Aires, South America, the State Department put out a warning saying people, especially older people, should not take cruises. And they left port anyway, and the world just started shutting down around them. And then they discovered COVID was actually on the ship, and we're just stuck out on the high seas, as far away as you can imagine from most of the world, as this disease just started picking people off one by one. And it's just really incredible. The more we dug into what happened, just the individual stories of heroism and part of these crew members on this ship that are underpaid, overworked, and were really just risking their lives to take care of what is basically like a shipload of everybody's grandparents, really just vulnerable people, right, especially then. who were just stuck in their cabins, terrified, and just waiting for this disease to come in and kill them by some unknown way.
Well, Michael, let me jump in for a second, because I think what is always so good, and it sounds like in your book, the specificity and the individuals telling their accounts what they saw. And this one excerpt that's in the book and in the magazine, I should say, you talk about this individual, George, walking into the packed kitchen of the cruise ship and asked in a booming voice, "What do you need?" And we obviously find out, as you detail, they needed a lot. What was it in terms of the specifics that really just jumped out for you?
Well, what jumped out for me was in that particular scene, if you will, which is all real, is that he was one of about a dozen volunteers who were working on other ships, and they put out a call, we need people to come and help relieve this overworked and ever sickening crew on this other ship, and just help them run the ship, because if not, it's just going to be a disaster and the ship will not be able to function. And so he was one of the ones who heeded the call very courageously. He knew, or he suspected, that he was getting into a situation where there's COVID, although he didn't really know. I think he sort of hoped it wasn't COVID. But he just went for it, and it's quite remarkable. And the fact that the reason people were just sort of overwhelmed by joy when he came in and said, "What do you need?" Is that they were at a point of desperation. I'm talking about the people who were working on the Zandam, who'd been fighting this for many days by then. And the fact that someone from the outside world was actually coming on board at great risk to help them was just emotionally more than any of them could take. And of course, when he got on and realized how bad it was, he started saying, I should have listened to my wife, because his wife, he's from Romania. His job on this other ship called the Amsterdam was to run the shops on board, like selling jewelry and overpriced, scarves and stuff. And he has his little kids at home back in Romania, and his wife said, "Are you crazy? Why are you doing this?" And he's like, "I just got to do it." And so, one of the first things he thought of when he realized how bad it was I should listen to my wife. But he stuck with it. And that's what's so striking about the story to me, is that you had so many people like that who were working that ship, who really risked their lives, and were just plunged themselves into a chaotic situation that was COVID at that time in the world. We were all going through this. One reason I think that the book sort of resonates with almost everybody is that it takes you back to those days when you were like scrubbing your groceries with antiseptic wipes, or like not, putting them in the garage for a couple of days because you were afraid you would get COVID from the, your box of cereal or something. Which now seems almost ridiculous because we know so much now. We're all vaccinated, or most of us are. But to me, it was like that on turbocharged. It just takes you back to that time and how dangerous things were. But it also takes you to a place where you're really happy you survived.
Right.
And that's the way.
Mike, the other element that I just want to touch on, because it's so central to the excerpt, and it's sort of the last question here as we wrap up and only have a few more seconds. But, really the penultimate tension here is Panama, right? Like the ship makes it all the way around South America, and then, it culminates with this idea of the canal, right? And how did that play out quickly?
Well, you're right. Panama did not want to let the ship through because when they publicly announced that there was COVID aboard, which is in this excerpt, that triggered a basically prohibition on any ship going through the canal with a COVID case on board, because the Panamanians were rightfully worried that the disease would somehow jump off the ship onto land, or more critically, the canal pilots, which there are only a few that have to take every ship through the canal, would all get sick, and they would have to shut down the Panama Canal, which would have been cataclysmic.
We got to run. This is a great read. Check out the magazine. Check out the book. Michael Smith and Joel Weber of Bloomberg Business Week.
Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close with 60 minutes left in the trading session. Caroline Hyde, Romain Bostic, Taylor Riggs, joined now by our colleagues Carol Massa, Tim Stenovic. I don't know what they're made of, pure caffeine right now, having just flown their way back from Dallas, but we thank them as we go cross-platform, TV, radio, YouTube, to dissect what is looking like the worst week for the S&P since January, the start.
Yeah, we missed talking with you guys over the last couple of days. It has been a rough week, and I continue to look for some outperformance in this financial market. I continue to find it on certain days when it comes to those Chinese names that trade here in the United States. Once again, outperforming, up nearly 4% in today's trade. The Chinese central bank has accepted, or there's reports that they have accepted Ant Group's application to set up a financial holding company, so giving a lift to those Chinese names. This group, though, Tim, up about 40% since mid-March.
Okay, one group not up over the last week is energy, seeing a major sell-off this week. Look at this, down 16%. This is the State Street Energy Select ETF. Large-cap U.S. energy stocks continuing to slide as crude oil falls today 6%. This is about concerns of a recession. Look, this could be its worst week for oil. You have to go back to March of 2020, but this could be short-lived. It's a supply issue, of course, and with China opening back up, that could increase demand.
Be interesting to hear what all those Texans were telling you down there in terms of the oil market, because I guess that size and scope shows you how long it has been rallying for. And overall, Taylor, we are seeing an S&P that drives higher on the day. At least it's not making up for the loss of the week. That's now off by 5.4% on the week, but we are up 0.6% on the S&P 500, 23 points higher. Volume significant, up 43% versus your average. Dow up 0.4%. We're seeing it down 4.3% on the week, though. NASDAQ up 1.75% at the moment. Thinner volumes there, and we're still down more than 4% on the week. And Russell 2000 up 1.3% on the day, 21 points higher.
And what a week it's been. Every sector now off at least 10% or more, except for energy, of course, year to date, which is still up about 33% or so on the year. But it's sort of been a big volatile week that saw us sort of re-enter that bear market and a lot sort of dragging us down lower. So at least on the day, we're trying to get a little bit back of that positive news here. Tech, of course, discretionary, financials, classic risk on. Those are each up about 1% or so. And then, of course, energy, actually the big laggard on the day with crude oil prices falling. Romain, as you mentioned about 30 minutes ago, energy, you're off about 5% or so.
Yeah, I mean, you talk about energy, Diamondback Energy, one of the biggest decliners in the S&P 500 on a weekly basis, down 21% this week. That includes an 8% drop that you're looking at right now. Meanwhile, you look at FedEx. That's actually your best performer on a weekly basis. One of the outperformers even here on the day, up 2.6% on this day and about 12% here on the week. And that's largely, of course, because some of the changes that company shifted on under activist pressure, including that dividend and some commitments here to capital spending. Some interesting commentary, of course, coming out of China. You mentioned those Chinese tech stocks here. Obviously, you had that that sort of tentative approval of that Ant Group deal, but also some interesting commentary by the head of retail over at JD.com. And actually, it wasn't very good here. It was a lot of talk here about people aren't spending as much online over there in China. Nevertheless, the ADRs here are up about 5.5%. And I don't know what's going on here. Apparently, people, Caroline, have stopped dating. Match Group shares are down 4%. Bumble is down about 5%.
The folks in the makeup room say they are dating.
And are they doing it online or are they doing it the old-fashioned way? They just go down to the bars and just hang out in front and wait for somebody to hit on them? Is that how they did it in the old days?
Online.
Well, not according to not according to the stock market today, at least, I guess. Well, there's not much better news out there when you're looking at what's happening in terms of the week's performance. Let's get out of the world of dating for a second and go back to the world of, well, we're not loving our stocks particularly. We have seen the Russell 2000 off by, as we said, 8% on the week. This is ugly in comparison. Our radio audience is basically just showing what a dramatic sell-off we've had across every major benchmarks for the week. And basically, we're now down 10 out of the last 11 weeks.
Yeah, that's pretty rough. All right, so the Fed giveth, the Fed taketh away, and we really saw that big time this week. A lot of commentary, of course, from Jay Powell of the Federal Reserve in that decision and press conference come Wednesday. Well, the Fed chief making his first public comments since that meeting, and again reminding us of his mission to really bring down inflation. Here's what he had to say at an event in Washington.
The Fed's strong commitment to our price stability mandate contributes to the widespread confidence in the dollar as a store of value. And to that end, my colleagues and I are acutely focused on returning inflation to our 2% objective. Meeting our dual mandate also depends on maintaining financial stability. Our commitment to both the dual mandate and financial stability encourages the international community to hold and use dollars.
All right, and that, of course, was Fed Chief Jay Powell at a Fed conference in Washington. Very simple, very dry, very Fed speak, if you will. I think the question is, Tim, like, how do you do it? How do you bring inflation down, and how long will it take ultimately?
What is it going to take to get there? What tools, to what extent are they going to use the tools they have available to them? And again, I know I sound like a broken record here, especially when so many of these things are supply driven and the Fed doesn't have the power to pump more oil.
Well, it doesn't have the power to pump oil. It doesn't have the power to do a lot of things. And I think that's why there is some skepticism here. I mean, when you have a Fed that has made clear, Jay Powell has made clear publicly here, that their ability to sort of control the core parts of inflation, you know, the stuff they normally overlook. The idea is that if they can't control that with the sort of traditional monetary policy measures, then that means that the effect of monetary policy, what's going to be that effect? Does it take the inflation rate down from 8% plus down to maybe something halfway down, 5 or 4%? But what about the rest of that? And I think that's where some of the concern is right now.
Although worth remembering what a global story inflation is at the moment, with 8.6% in the US, in the UK it's 9%. We're looking at parts of Europe where it is in an 11% range. Goodness knows what, of course, where we're at in terms of Argentina and Latin America. It's interesting. I felt like he was sort of poking the crypto bear there a little bit. It's like the dollar as a store of value and with stability. And I mean, crypto this week has shown it is not that for the time being.
One of the worst weeks we've had, I think maybe in the last year, if not going back since about March of 2020, on sort of a risk asset, risk off kind of day. I mean, it was interesting. We were talking about the difference between core and headline. I did think that it was fascinating that Jay Powell did mention to Mike McKee's great question that, yes, he is still watching headline because he understands the food and the energy. And that was sort of the first real time when you've heard him, you know, of course, focused on core, but really also highlight headline inflation as well.
Yeah, and he also made clear in his answer there that that differential between headline and core, that's sort of the gap that the Fed can't necessarily fix. And it'll be interesting, we should point out, of course, Jay Powell's going to be on the Hill twice next week for that semi-annual testimony. Obviously, he's going to get peppered with a lot of questions, not so much about sort of the nerdy in the weeds stuff when it comes to a monetary policy, but about what real people are really feeling on the ground.
We also get an important read on consumer sentiment again and expectations, and that's something we know Jay Powell is watching. I just want to let you guys know that the shots that Tim was buying, the tequila shots down in Texas, they were kind of expensive.
Tequila shots.
Is that headline or core?
You know, true story. My corporate card was declined, so I had to use Carol's.
Well, mine was too, but apparently it was the reader. It was the reader.
Wow, what's going on?
I don't know.
All right.
I thought you two were like the golden child. Golden children.
What about mezcal? It's niche and it gets expensive.
It gets expensive. All right, we're going to come back in less than an hour's time. We're going to wrap up this trading day, this trading week.
Taylor has no idea what you're talking about.
Our cross-platform coverage, radio, TV, and YouTube. We call it Beyond
Thoughts
the
on
Bell.
the word Amex.
Can we go back to talking
Friday.
about dating? Can we just do that? All right, we'll be back in less than an hour's time on Bloomberg.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Did you notice food was expensive?
Yeah, I didn't know if it was expensive just because we're at a resort and
that's
you know
fair.
where they're essentially holding you hostage and you can't go anywhere else.
Yeah.
But when you live in New York, and this is what I think is so funny, when you live in New York and you go to airports, you don't think the food is actually that expensive because that's how much food costs everywhere.
That's true.
Even though I had dinner, I got some fast food in the airport yesterday, and it wasn't too expensive.
The bottomless pit of Tim Stenovic.
You got to eat.
We actually
okay?
ate, and then you're like,
You got to.
What were you?
Well, that's because I
Chick-fil-A?
skipped. Yeah, but I skipped lunch, so
Yeah.
that's why.
I had some Pinkberry, you had some Chick-fil-A.
Exactly.
We're going to continue talking about a lot of the headlines, including crypto headlines. I had a great discussion at BNY Mellon Pershing Insight because it was about the future of money. How do we reimagine it? I had two great crypto guests, which I promise you we will bring you on air in the weeks to come. We had Matt Hogan of Bitwise and Matt Walsh of Castle Island Ventures. Sorry,
Yeah.
this is what happens when you only have 3 hours sleep.
And yeah, they were great, Carol.
Yes.
And I want to go back to what Caroline said about Fed Chair Jay Powell, about his comments about the dollar being a store of value, because people have thought that crypto is a store of value, Bitcoin specifically, down this week, Carol, 25%.
But didn't Abigail just talk about at the top of the show, saying if we're starting to see some buying and potentially a bottom in it, is that also a sign of market capitulation?
Guggenheim Scott Minerd saying it was a canary in the coal mine for the equity market.
What did he think Bitcoin would go to?
100,000 at one point, but I don't know what his most recent read is.
It still could. Many crypto experts would say it's just going to take some time.
All right, let's get to Denise Pellegrini, who's standing by in the newsroom right now. Hey, Denise.
Hey there. Well, one thing that's not helping sentiment on Bitcoin today and other crypto, Babel Finance is freezing withdrawals. And as you know, this is the second major digital asset lender this week to do so. Dozens of COVID vaccines for kids under 5 could be shipped out Monday, the White House says, and those shots could be in kids' arms as early as Tuesday. FDA Commissioner Dr. Robert Califf.
We expect that the vaccines for younger children will provide protection for the most severe outcomes of COVID-19, such as hospitalization and death.
And final CDC approval is pending. We're tracking it all for you here on Bloomberg Radio. President Biden blaming oil companies for sky-high gas prices. He says they have leases for drilling but are not acting on them.
They have over 9,000 leases. 9,000.
And Biden commenting on his way to Delaware. The House Select Committee, as we've been reporting, investigating the January 6th insurrection, preparing for its 4th public hearing next week. The last 3 giving some insight into how former President Trump tried to stay in power, and former Baltimore Mayor Stephanie Rawlings Blake among those who finds the things coming to light disturbing.
We got to see in real time the strength, the weaknesses, hopefully some opportunities and the threats to our democracy by what happened on January 6th. And I'm praying that we learn these lessons and make sure something like this never happens again.
Former Baltimore Mayor Stephanie Rawlings Blake. And a new book by a former Goldman Sachs employee says she suffered widespread abuse, including being lifted up by her jaw and being mooed at when she went to pump breast milk. Goldman says it strongly disagrees with Fiore Higgins' characterization of Goldman culture, and the memoir Bully Market comes out in August. Global News 24 hours a day. I'm Denise Pellegrini. This is Bloomberg.
All right, Denise, thank you so much. Carol Master, Tim Stanovic, we're live in our Bloomberg Interactive Broker studio. We are streaming on YouTube on this Friday from Bloomberg headquarters in New York City. Safe to say, fast and furious when it comes to crypto headlines every day. And a lot of them speak to the troubles that are out there.
I want to get to this Wall Street Journal story. I mentioned it on our editorial call this morning when we were talking about crypto. Because I saw it, I don't know when I saw it, Carol. It could have been some point on the plane last night. It could have been when I couldn't get to sleep at 3 a.m. But the crypto-focused hedge fund Three Arrows Capital, I'm reading this from the Wall Street Journal, Dow Jones, has hired legal and financial advisors to help work out a solution for its investors and lenders after suffering heavy losses from a broad market sell-off in digital assets. That's according to the firm's founders today.
All right, and this is not something that just started last year, last month, last week. It's been around for a decade.
Yeah, and this comes after we got the news that companies, like Celsius essentially being insolvent. We got layoffs at Coinbase this week, Carol. You have other companies doing mass layoffs in the crypto space as a result of declining interest and declining asset prices.
Right, and you get into kind of some transparency in where they were investing. 3 Arrows invested about $200 million in Luna as part of a specific deal, some that was effectively wiped out when Terra USD and Luna both became worthless in a matter of days. Those two cryptocurrencies were previously among the 10 largest digital coins before they lost a total of $60 billion in market cap last month. Again, I'm reading from this story from the Journal.
We also got a great story by our own Muyao Shen about the crypto tumult spreading as the lender Babel is putting a freeze on withdrawals. This, she writes, is a sign of deepening turmoil in the crypto community. Babel Finance becoming the second major digital asset lender this week to freeze withdrawals, telling clients that it's facing, quote, unusual liquidity pressures as it contends with recent market declines.
And all of this news coming just a few days after Celsius Network, another crypto lending platform, paused withdrawals, swaps, and transfers in an attempt to stop the digital asset equivalent of a bank run. I mean, this is what's going on. When I was talking with Matt Hogan, specifically at Bitwise, and I said, these names, first of all, I think about my grandparents listening to this, and they'd be like, it's a foreign language. He's like, it is. These names, these companies, all of it is just still very new.
I want to know what this all means for adoption.
We don't know. And most of these guys would say it's like the early days of the internet. This is Bloomberg.
Connection lost.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. We've got stocks trading mixed ahead of a long holiday weekend for a lot of people. Choppy session, the Dow now back in the green. S&P, NASDAQ, they're also higher. Let's get all the details now as we head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks quiet, and like you said, in a choppy session. Dow's currently up 10 points, S&P's gained 11, while NASDAQ is outperforming, up 145. The U.S. 10-year yield at 3.24%, gold is down 21. Oil is sinking, and Bitcoin is down by 1%. Among the main 11 S&P sectors, leaders were telecom and tech. Energy and utilities led to the downside, and leaders to the upside in the Dow, American Express, Boeing, and Salesforce, while Chevron fell 4%. And led to the downside. After earnings, Adobe paired losses of 7% to trade little changed. And in deal news, Dow Jones reported that Merck is eyeing a purchase of Seagen and United Health to acquire UK's EMIS for $1.5 billion. Wrapping things up, Powell says the Fed is acutely focused on returning inflation to 2%. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill. And to hear live breaking news over your Bloomberg type Squawcast, QUAWK on your terminal, I'm Charlie Pellet. That is a Bloomberg Business Flash.
Yes, it is. All right, Charlie, thank you so much. So lots of headlines, Charlie, covering a lot of them in the world of business. We've been covering a lot of the crypto headlines as well. Our own Olga Karif writing about how crypto traders are turning against each other, Tim, in a collapsing market.
Yeah, we mentioned the challenges that the crypto community has had this week when it comes to Celsius. We got Three Arrows as well. Babel, as Muyao Shen wrote for the Bloomberg Terminal. Let's get to someone in the crypto community who can help shed some light on this. Noah Buxton is a partner and practice leader of blockchain and digital assets at Armanino. He joins us on the phone from San Francisco. It's good to have you with us, Noah. I mentioned some of the big headlines just from the last few days at this point, not to mention Coinbase layoffs, close to 20% of the firm. My question for you is about adoption. When consumers who haven't dipped their toes into crypto see stories like these, and then consumers who've gotten burned on crypto with declining asset prices, what does that do for widespread adoption of the digital asset?
Yeah, Tim, thanks for the question, and Carol, thanks for having me. Yeah, certainly this puts caution, right, in people's minds. It puts additional skepticism as well. The headlines right now are certainly not great. If you're thinking about, hey, what is this new technology? How do I get my mind around it? What are the investment potentials or opportunities in here? And then all you hear is bad things, right? So, of course, it puts a temper. It chills the market when it comes to new entrants. That's for sure. And that happens in every crypto downturn, right? We have sort of the new entrants. The wheat is separated from the chaff, and unfortunately, yes, some people get hurt in these investments. But what we see is, what I see on a daily basis is a core set of companies that are innovating, that are truly doing good work in terms of democratizing finance, opening up additional opportunities, interesting financial products that I think will be important for our future. And so there's a lot of good innovation that's still happening behind the scenes.
And so I have to say, nascent innovation, I mean, for the folks that we keep talking to, and I mentioned a crypto panel I did out at BNY Mellon Pershing Insight this week, with two individuals who are very well versed in the crypto space and being very realistic that this is the early days of the internet, and that the timeline on this, and there's going to be a lot of fallout, which we're seeing right now, that Noah, the timeline is probably a lot longer than we all realize when it comes to the credibility.
Sure, yeah, I don't think that's an unfair assessment by any means, right? I think those of us that work in this every day had gotten pretty comfortable being at a $2 and $3 trillion market cap. Hey, we feel like a real market now. Look at us. And Bitcoin itself was $1 trillion asset class. And we saw institutional players in the space start to treat it that way, right? This is a institutional quality asset. It's a digital commodity. And when that value is stripped out very quickly, yes, you realize that, wow, we actually have a very, very shallow market. And so these things move very quickly. And also the credit moves differently in crypto as compared to traditional markets. And so that's why we see these very, very fast bottoming outs that can happen.
Yeah, I want to build on that a little bit because I think about what our Bloomberg Markets Abigail Doolittle said earlier today about the idea of looking to Bitcoin as a sign of capitulation. And it reminds me of what Scott Minerd over at Guggenheim said on Bloomberg TV just a few days ago after Fed Chair Jay Powell spoke. The idea that crypto is canary in the coal mine for risk assets like equities. And I'm wondering what the crypto market can tell us about the way that other asset classes are going to move.
Yeah, that's an interesting perspective. I do see crypto as a very free market, honestly. I think that, when we see, as I just mentioned, for instance, the credit tightening quickly. So I do think that there's a canary in the coal mine aspect, and I think it's also fair to look at the equities markets today and say, wow, look at PE ratios. This seems a bit disconnected from reality. But why does that move slower? Why are we not seeing downturns? There are many reasons, of course, but I do think that some of those reasons are there's an infrastructure of credit facilities. There's a lender of last resort. There's a whole infrastructure of sort of trust and transparency in those markets, right? Public companies do reporting. There's a rich market of analysts that analyze all that data and keep markets comfortable and informed. And so that leads to fair, orderly markets, ultimately, with good price discovery. And liquidity injection for traditional markets doesn't hurt either. But we don't have that in crypto markets. So I think, the other point that I'd like to make, I see on the daily basis is that, I have a pretty sober view of this. I think that there are certainly trusted players in the space, and there are certainly those that have a lot more work to do. And I think that we can see real differentiation. So one of the things I work on every day is providing that trust and transparency, right? We're a large CPA firm.
Right.
And we see this differentiation on the daily, right? So what we see happening with Celsius, what's happening? It's really a lack of customer trust. It's a lack of reporting from the company to engender that trust and give customers what they need to trust those services and see that their assets are adequately backed or reserved. You can contrast that with
and I would jump in, Noah, and just say, because we're running out of time here, but that's why people respect something like the U.S. dollar. Like, there is something behind it, and there's credibility and respect. And I will say, on my panel, folks were calling and said, we do need some regulatory oversight that will give it, certainly the crypto market, some credibility. Noah Buxton from Armanino joining us on the phone from San Francisco. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's a wacky Friday, everybody.
Oh, yeah.
I'm just saying. All
Markets
right.
aren't even closed yet, Carol.
I know. Where are we? We're still those bouncing around.
Yeah, I don't know if you saw what happened yesterday.
Yeah, I did. I got that. Among our most read on the Bloomberg. Well, it's about media. That's all I'm going to say.
Yeah, we're really excited to chat with Jerry Smith, media reporter at Bloomberg News. We're going to talk to him in just a minute. First, though, Charlie Pellet, less than a half hour to go. What's it looking like?
And we're looking like green on the screen. Choppy session, though. It's we've got the Dow, the S&P, NASDAQ all higher, but as we heard from Bill Maloney, we are seeing swings between gains and losses. Let's start with the key points as we wrap up the trading week. 28 minutes to go. The Dow right now above 30,000, barely at 30,004, up by 0.3%, higher by 71 points. S&P 500 index holding on to a gain of 18 points, up now by 0.5%. NASDAQ up 172. Tech leading the way higher today. The NASDAQ Composite Index up 1.6%. The NASDAQ 100 Index up by 1.4%. 10-year yield 3.24%. Spot gold down $21 the ounce, a drop there of 1.2%. And the price of crude oil, big story today, $110.29 on WTI. West Texas Intermediate crude down 6.2%. Stocks rallying after struggling for direction in the early going as traders parse comments from Federal Reserve officials reiterating that the central bank has to do more to curb the hottest inflation in 40 years. Well, as for the market outlook, Nadia Lovell is senior U.S. equity strategist at UBS Financial Services. She told us she's pulling in her estimates.
We've reduced our price target for year-end for S&P 500 to 3,900, and a lot of that has to do with our earnings expectation as well as our valuation multiple. You know, inflation is running hot. The economic data is softening, and we've seen weak retail sales numbers this week, weak housing starts, and we have a Fed that's hiking into all of that. That's usually not a good recipe for any sort of sustainable rally in the equity market.
And again, we do have the S&P pushing higher by 21 points now, up by just about 0.6%. Briefly, TikTok, the popular Chinese-owned video app, says it has reached an agreement with Oracle to store data from American users on Oracle servers. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So you know what media love reading about?
Media. Solipsism. It's my favorite word.
I love that.
Yeah.
Is that an SAT word?
No, but it's like when we only care about what's in our own universe.
Well, this is certainly that case, and it is among the most read, because it turns out that actually the Bloomberg universe cares about this story as well.
You know, someone I care about personally is Jerry Smith. He's media reporter at Bloomberg News. He joins us on the phone from New York City. Jerry, your most recent story is all about the new CNN boss, Chris Licht. He came from CBS, and he is obsessed with ratings. What's he got cracking at CNN right now?
Well, yeah, he's a former TV producer, so TV producers obviously focus a lot on ratings.
But like this guy will miss his best friend's wedding because of sweeps week, or he'll, be recovering in the hospital, as you write.
He wrote a memoir, actually, where he mentioned those details, so I included that in the piece. CNN has, the ratings have not been great. I mean, all the cable news networks have really struggled to keep up the audience that they had during the Trump era, but CNN's actually fallen further than Fox News and MSNBC over the last several months. So, it makes sense that he is exploring ways to make money that doesn't have to do with ratings. I mean, he's looking at everything from CNN's website having a premium section where only paying subscribers can access it. He's looking at creating segments of shows that are sponsored by advertisers. And he's also looking at, really growing some of the international CNN channels, particularly CNN in Espanol.
Well, I do wonder, Jerry, is this a case of, a strategy that the network needs a new strategy, or is it just a case of lack of Donald Trump that fueled ratings, as you know, kind of across the cable spectrum, certainly the cable news spectrum?
Yeah, I mean, the Trump era was a bonanza for all the cable news networks. And so everybody really across the whole media industry is dealing with that. Even, publishers are struggling with having the same traffic they had during the Trump era. I mean, for CNN, they also were really notable during the Trump years for really being aggressive and pushing back against Donald Trump. I mean, their anchors would even make headlines themselves by, expressing some strong opinions about Donald Trump. And Chris Licht, he's taking over for Jeff Zucker, who really encouraged that kind of really aggressive, opinions from some of the anchors and hosts. And Chris Licht is really trying to dial that back. There's business reasons for that. I mean, advertisers would presumably be more comfortable advertising with a channel that isn't as politically controversial. And if you think about the Trump era, when Trump and his allies would really go after CNN, calling it fake news, he's really trying to dial that back. Also, CNN makes more money from its cable distributors than it does from its advertisers. And cable distributors have seen a lot of pressure in the last couple of years from consumers who say, we want you to drop this controversial channel. I mean, we saw One American News Network will lose its spot on DirecTV. So Chris Licht is trying to just make CNN more focused on just covering the news and being a little bit less divisive.
Is it a question, though, too, of where the white space is in this environment? Because on the right, you have Fox News and Fox Business, and on the left, many argue you have MSNBC filling that space, though I wouldn't say the two are exactly equivalent with the space that they occupy. So CNN, because those polarizing things, Jerry, those bring eyeballs.
They do, but yeah, you're right. I mean, I think what Chris Licht also sees is CNN can play to its strengths by focusing on news. I mean, they have a much larger staff of journalists around the world than Fox News and MSNBC. And Fox News and MSNBC are really catering to viewers on the right and the left. So he sees an opportunity here to, if they can just focus more on covering the news and there's people who want that. And I mean, if you look at their Ukraine coverage, I mean, the viewership, viewership was up and people turn to CNN when there's big major news around the world.
It's interesting too, Jerry. Don't you feel like I remember, the first Persian Gulf or the Persian Gulf War, like you went to CNN to know what was going on. And there were a lot of reasons that they were doing. Exactly. Like you went there as a, this was a news source that you trusted, relied on, and you could get the up-to-date information. It almost feels like they're going back to their roots and just got about 25 seconds.
Yeah, that's right. I mean, I think he's generally trying to just focus on news and be a little bit, as he put it, less alarmist. I mean, one thing that got a lot of attention recently was he said that CNN should use its breaking news banner less, that that they were overusing it and that they want to inform their viewers and not alarm them. So that's, he's a little over a month into his job, but I mean, right now he's really trying to kind of get them to recalibrate and go back to the way they were maybe before the Trump era.
Not everything's breaking news. Just news alert. Red sticky on the Bloomberg. Story. Jerry Smith, media reporter at Bloomberg News. There also was the Scud Stud back during the Persian Gulf War.
Who was that?
The reporter Arthur Kent.
Oh, nice reference.
I think that might have been NBC, though. Or maybe it was CNN.
All right, let's go over to Denise Pellegrini. She's standing by in the 1130 newsroom in New York. Hey, Denise.
Hey there. Well, speaking of the investigation into the January 6th insurrection, former Vice President Mike Pence in the spotlight. Pence refused then President Trump's pleas to overthrow the 2020 presidential election results, and he's not saying much about it. But he is apparently preparing for a presidential run, according to former Trump administration official Sarah Isgur.
Mike Pence also appears very much focused on a 2024 presidential run himself. He has visited Iowa, New Hampshire, South Carolina 3 times apiece. He was even in Ohio helping some of those Republican midterm candidates. He wants to draw a distinction between himself and Donald Trump, but he also doesn't feel the need to antagonize Trump's supporters.
And that's former Trump administration official Sarah Isgur there. Meantime, Trump's former trade advisor, Peter Navarro, has pleaded not guilty to criminal contempt. He's declined to testify before the committee and refused to hand over documents, and he's asking a federal judge to hold off on his trial so he can promote his book. And the FDA has approved emergency use of Moderna and Pfizer COVID-19 vaccines in kids as young as 6 months. More from Bloomberg's Amy Morris.
Days after an advisory panel unanimously signed off on the vaccines, the FDA is now giving the green light to the shots for young children. The Moderna vaccine is now authorized for children 6 months to 17 years old, and the Pfizer vaccine is authorized for children from 6 months to 4 years old. Once recommended by the CDC, the shots will become available as early as June 21st. The federal government has secured a supply of 10 million doses. In Washington, I'm Amy Morris, Bloomberg Radio.
All right, thank you, Amy. In global news, 24 hours a day. I'm Denise Pellegrini, and this is Bloomberg.
All right, Denise, thank you so much. Carol Masser along with Tim Stenovic here in our Interactive Brokers studio. In the meantime, a lot going on, but let's not forget that there is, I feel like the M&A world continues, or even just speculation about deals and talk of deals.
Yeah, this one in financial services. It's really fascinating.
Yeah.
BNP Paribas has expressed interest in a potential acquisition of ABN AMRO Bank. It's the Dutch consumer lender that's been government-owned since all the way back to the financial crisis. This, a Bloomberg exclusive, according to people familiar with the knowledge of the matter.
Yeah, according to this reporting, our reporting, France's biggest bank recently reached out for a meeting with the Dutch government and talked about its interest in a transaction, according to people in the know. ABN AMRO, we saw it soaring in Amsterdam, so we saw some real big reaction. No surprise as the possible target. It's been under some pressure this year, but it's fascinating. And I think, here's this like crazy market environment. And I mean crazy only in that the macro heads, we're still trying to figure out what's the outlook, recession, where, global, how long, deep, aggressive central bank moves. I mean, right? Like this is our world.
When,
and yet,
where, who, what, why.
Exactly, the 5 W's. And yet we do see companies continue to either do deals, talk about it, they're figuring it out.
Okay, we should note the Dutch government is not seriously examining the interest for the time being, and BNP's preliminary contract has not progressed to any detailed negotiations. This, according to people familiar with the matter. The state also, Carol, may prefer to sell down further shares on the market, which would allow it to raise money while retaining some control. That's according to one of the people.
I mentioned ABN AMRO shares soaring in Amsterdam. They were up as much as more than 18%, settling the day, though, with a gain still of about 5.6%. So the enthusiasm or expectation certainly got kind of pulled in.
Would be interesting to see some significant M&A happen in this volatility, right?
Oh, yeah. First of all, sub names by market cap, certainly publicly, are a lot cheaper.
Yeah,
even
I mean,
private companies are probably valued a lot cheaper.
I'm looking to private equity to see what happens, as some of these names continue to get battered down.
Yeah, something we'll keep an eye on. All right, folks, we're just about 17 minutes away from that close. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell and ahead of a long holiday weekend, and we are seeing stocks holding on to gains. S&P up 16 now, up by about 0.5%. Dow Industrials up 59, higher by 0.2%. Worth noting, though, that the Dow is below 30,000 at 29,976. NASDAQ leading the way higher, with the NASDAQ Composite Index up 157 points, up 1.5%. The NASDAQ 100 Index up by 1.3%. 10-year yield 3.23%. Spot gold down $20 the ounce, down 1.1%, $18.36 the ounce. And with a focus on inflation, crude oil tumbling 6.3%. West Texas Intermediate crude down $7.37 a barrel to $110.22. Stocks are higher after struggling for direction earlier in the day as traders parse comments from Federal Reserve officials, reiterating that the central bank needs to do more to curb the hottest inflation in 40 years. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
Although U.S. public school students faced plenty of challenges during the pandemic, most of them could at least count on one benefit: a guaranteed lunch. Waivers issued by the federal government in 2020 have enabled schools to serve meals free of charge to all students. With the waiver set to expire later this month, many of those kids are now at risk of going hungry. For the sake of their health and education, it's imperative for Congress to step in. The wisest course would be for lawmakers to extend the waivers for the upcoming school year, while mandating that states transition back to means testing in 2023. More than 2 years since schools first closed their doors, America's students are still struggling to recover. It shouldn't be asking too much to ensure that they all have enough to eat. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, we've got just about 10 and a half minutes left in today's trading session. What a week it's been. We have seen significant selling. Are these numbers right? Are we down about 17.5% on the Dow for the week?
No, not for the week. No, on the Dow, we're down 4.6% for the week.
Okay. What are these numbers I'm looking at? I got to check these. Oh, year to date. Forgive me. That's year to date. I'm down about 31%. I told you I'm only going on 3 hours of sleep, so bear with me. Thank you, Tim, for keeping me honest.
Yeah, anytime, Carol. S&P 500 down 5.7% for the week.
But so a fair amount of selling. So let's see if our next guest thinks capitulation or not.
Larry Pitkowski is managing partner and portfolio manager at Goodhaven Capital Management. Larry joining us this afternoon on the phone from Millburn, New Jersey. So, Larry, I'm going to just give you Carol's question. Capitulation, are we close?
You know, Tim, you can never really know if this is the bottom. I would say there are two very important sayings I keep on my desk and handy. One is by Sir Winston Churchill, which is never let a crisis go to waste. And for us at Goodhaven, that means using volatility to try and continuously look for better companies to invest in, to upgrade the portfolio, and to use the volatility to try and for the advantage of our clients and shareholders. And the other one I keep handy is by Rick Mears, a very famous IndyCar racer, which was to finish first, you must first finish, which means, you know, we try and make sure we always have some cash around. We are not running levered portfolios because in a crisis, those things really are very important, more important than ever before. And so all I can tell you is we have found plenty to look at. We like what we own. And, you know, there are more potential bargains than there were 6 months ago.
So wait, to finish first, you must first finish. So how do you apply that to this market?
Well, I think the point of the saying is if you are over-levered or you have no resources, you may have some interesting ideas, but you may not get to see it through. So I think as a portfolio manager, what it means is, being unlevered and having some cash allows you to control your own destiny and try and take advantage of the volatility that's going on out there, as opposed to the volatility taking advantage of you.
Okay, so let's talk about opportunities here and where you're seeing them right now. You guys are still bullish on energy, despite the fact that this week has been brutal. I mean, look, it's the best performing sector in the S&P 500 this year, and last year it was. Why still bullish on energy, even if there could be a recession, which could really crimp demand around the world?
Well, Tim, it's a very good question. I'd like to answer it by reminiscing a little bit with Carol. Carol, can we reminisce just a little bit on this part?
Let's do that.
June of 2017, I was on the show, and we were talking mostly about energy, and we were talking about one of our bigger holdings at the time, which was WPX Energy. Oil was $45. Not many people thought it was an interesting industry to be invested in. The stock was, WPX was $10. Oil was $45. It was a very unpopular area. And I thought it was interesting. I know you thought it was interesting. And here we are. Devon then acquired WPX. It is still an important holding for us. It has gone up substantially since then. But I think today, when you look at what Devon has done over the years, you have a very material dividend policy. They really were, I think, the first at what they call the fixed plus the variable dividend. The stock has been weak lately. It is still materially up from, our cost, which is a single-digit number. But if you look at it today, you're looking at a potential dividend yield of probably
almost 9%,
8%.
right?
Yeah. I would say north of 8% to be conservative. Even if oil were to come back to, let's call it, on the back of an envelope, $80 oil, $5.50 gas, they should still be able to generate $6.50 of free cash flow. So, we think it's interesting. It's been a holding for a while, but it's interesting again today. And, I think Devon and their brethren, to the credit of Rick Muncrief, who runs the show there, and to some of their brethren too, have really become focused on moderate production growth and using the enormous profitability to benefit, all of their constituents, including their shareholders and bondholders.
So, I mean, what you're saying in this energy play, though, too, to me is, and first of all, I love reminiscing, and I went back and I was on the Bloomberg, and I'm like, oh my God, yeah, they were acquired. It's interesting. And I do also feel like you are part of a theme and trend that I keep seeing, Larry, from people saying, look at some of those stocks that pay dividends. In an uncertain environment, there's kind of a certainty to it if you're looking for some performance. But going back to your energy play, even though we are moving to an alternative energy world, renewables increasingly, we've all got to be realistic about this timeline, especially with the war in Ukraine. Like, this is not going to happen overnight. So energy is going to provide some performance.
I think that all makes perfect sense, Carol. And, I think from our perspective, these things that are now front page items, energy prices, higher interest rates, inflation, they're all front page items, to use a phrase today. But we have been trying to think about them. We've written about them, and we've had exposure to these areas for a long time. And I think that's the idea, to try and, be ahead of what might be a trend. Now, having said that, we like to own primarily, good quality growing companies that are not very levered. But the Devon of today, we're willing to still have it as a material holding because we think their current policies, really fit in well, appropriately sized for, how I think about the portfolio.
Yeah. Okay, Larry, we have another minute with you, and I just want to get your take on where you're seeing the Fed right now. Do we see 75 basis points at the next meeting? End of July?
First of all, I'm sorry to have to disappoint you and tell you that I don't know, but I will say that higher interest rates.
All right, we're done, Larry.
We're something that we've thought about for a long time, and we have a bunch of companies that will benefit from higher interest rates. And Chair Powell seems quite determined, to not let inflation get out of control. And we had something in the financial sector, which was Allegheny, which was a property casualty insurance company, which the type of thing that will benefit from higher interest rates, which Mr. Buffett in Omaha is buying out from us very shortly. So we've thought about this for a while. There are ways to try and look for companies that might benefit from higher interest rates. But as far as a prediction on the Fed, I'm sorry to disappoint you. I don't have it. We'll just try and pick stocks and worry about risk.
No, it's actually a really important perspective, right? There's just so much you can or cannot control when it comes to macro, and so you've got to dig into the fundamentals of specific names and make investment decisions based on that. Larry Pitkowski, Fund to Reminisce, Managing Partner and Portfolio Manager, Good Haven Capital Management. Have a good and safe weekend. Joining us on the phone from Millburn, New Jersey. We have just about 3.5 minutes left in today's trading session, getting ready to wrap up the day and, of course, wrap up what's been a wild week and one of the most important Fed meetings in some time. Right now, we're going to head over to our TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and YouTube. We're counting you down to the closing bell on this Friday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell. Here to help take us beyond the bell. It's our global simulcast, joined right now by Carol Master and Tim Stenovic. We welcome our audiences across Bloomberg Television, radio, and YouTube to parse the crucial moments of this day and, of course, this week. Carol, a week that started off with the S&P going into a bear market where it remains right now.
Yeah, a significant one and a very significant Fed meeting that we had this week. And it's interesting to see the S&P and the NASDAQ, and especially the NASDAQ outperformance here in the green. Worst performing name in the S&P 500 this week. Anybody want to guess?
EOG?
Coterra. Best performer? And best performer?
FedEx.
You got it.
Oof. Oh, very impressed.
It's like the Friday Bloomberg quiz.
Wow, nicely done.
Hey, a lot of superlatives this afternoon. If we do see stocks stay where they are on the S&P 500, it is going to be the worst week since March 20th of 2020. Though, if we do see just a little bit of a recovery, we might go to, the worst week since January. So, might come back. We have a couple of minutes.
Well, they got some fighting to do as we go into the close. It's interesting. We have got a fair bit of volume as we march towards it. As we know, triple witching. We put one witch to bed. We also, of course, have the overall concern about going into a shortened week, what next week brings and what next week Fed Chair Powell brings. Because remember, he's got yet more words of wisdom and more eyes on what he's going to say up on the Hill.
And I don't know if those words calm us now or make us more volatile when we start to hear from them. Really tackling 2% inflation, that doesn't sound new, but when they speak, it certainly sounds like we get some jitters in these markets.
Yeah, and I mean, we should point out, too, I thought the commentary by Esther George today was quite interesting. This idea that, coming out with 75, when you basically communicated 50, that creates a big credibility issue. It'll be interesting to see what the debate is at that next big meeting, which we're still, of course, a month or so away from. Closing bells here on Wall Street. We should point out the Dow Jones Industrial Average, which has actually been oscillating between gains and losses for a good portion of the day. It is going to finish the day down in the red, only by about 0.1%, down roughly about 43 points, and it's going to be down on the week by about 5%. The S&P higher by about 0.2% on the day, and lower by about 6% on the week. The Nasdaq Composite, that's your outperformer, up 1.43% here on the day, though, still finishing out the week down by about 5%. And we take a quick look here at the Russell 2000. The Russell 2000 actually had a pretty good day. You did see some of those cyclical names get bid. It moved up higher by about a percentage point, but nevertheless down for a third straight week, 7.5% loss on a weekly basis.
Yeah, one of my gainers in the Russell 2000. I'll get to that in just a moment. In the meantime, I want to talk a little bit about the VIX here, because the VIX closing down about 2 points, almost pretty much where it started the week here. On Monday, it started about 31, and we're closing pretty much at 31 on this Friday, despite all of, Taylor, the big market moves and the nervousness and the concerns and the volatility. The VIX ending pretty much flat on the week.
And we still don't have that sort of 40 handle, Carol, which I think is so interesting. So many investors looking at that sign for signs of capitulation, right? You certainly didn't get capitulation here today for radio audiences. We do sort of deep dives underneath the surface here to really understand some of the big sector winners, the big sector losers. There is a lot of green on the screen, Carol, on days like today. It feels classic risk on media, auto components, telecoms, some of the tech, hardware, and equipment as well. Those are each up more than 1%. Down at the bottom of the screen, there's also some significant red here. Some of this is household products, utilities, food and staples, energy, sort of an unwind of some of those big inflationary hedges. Kroger, I know, was certainly one, Carol, that we were talking about earlier, maybe not being able to pass along some of those costs. So energy, the worst performer here too, also off about 6% on the day.
All right, so let's get to some of the specific gainers. Carnival atop that list, that and Norwegian atop the S&P 500 today. Carnival up almost 10% in today's session. We talked with the company's CEO on Monday. He talked about being recession resistant. You can catch the full conversation on our broadcast and podcast. A little bit of a shameless plug there. What's interesting though, in terms of stories, Carnival partnering with BetMGM, what?
Nothing, Carol. Keep going. Those are just the voices in your head.
It is totally, you can, there's tons of voices in my head today. Carnival partnering with BetMGM to offer mobile wagering on more than 50 cruise ships, the latest sign of the increasing popularity of sports and online betting. Keep in mind, a week from today, they are reporting results as well. Also want to mention CGen, ticker SGEN, that stock up about 13%, top of the NASDAQ 100. Merck said to be eyeing a purchase of the company, according to Dow Jones. Other unnamed suitors also said to be eyeing the company. And then this one's for you, Romaine, because it's top in the Russell 2000. This stock up about 29%, was up 61% at one point in today's session.
I don't understand the story.
Well,
like, why would it rally off of not doing a stock split when it's at like 76 cents a share?
Well, because it would have been delisted, apparently. And so they're doing it to avoid a potential delisting. Do I actually know something that you don't?
Wow. I mean, miracles do happen.
Wow.
I had an on-air correction.
I am done. I'm done with my career. Okay. All right, Tim, take it away.
Okay, Taylor, you talked about energy being the worst performer today. ExxonMobil is where we got to start. The shares of the company finished the day down by close to 6% today. Oil and gas stocks just continuing to slide today. ExxonMobil on a points basis, the biggest drag on the S&P 500, though. We got Chevron there at the top, ConocoPhillips, Schlumberger, all were there as well. I want to talk about Kroger, another one you mentioned, Caroline, another one you mentioned, Taylor, finishing the day down by 7.3%. The company reported earnings yesterday. Gross margins missed estimates. Now you have analysts weighing in, including Morgan Stanley, who says that Kroger's quarterly gross margin miss shows how it could struggle to pass along those higher costs, especially as CPG makers also pass through additional rounds of higher costs to retailers such as Kroger. And then I want to check in on home builders. Dreamfinder Homes finishing the day down close to 10% today. The S&P 500 Super Composite Home Builders Index slumping more than 13% this week. Biggest drop since April of 2020. We saw what happened with mortgage rates surging. We also got those housing starts yesterday. They were softer than expected. Dreamfinder Homes got a market cap around $1 billion, falling close to 10% today. Bank of America downgrading the stock. Bank of America saying that it expects a pause in housing market demand to last into 2023.
I'm really intrigued by this story because, I mean, we had Rohit Gupta over at Enact, the big mortgage insurer, on a couple days ago. And, he seemed pretty confident that he thought mortgage activity would continue, at least with regards to buying, not necessarily refinancing. And he actually saw a lot of strength in this market. But I don't know. Well, we're hearing from some of these home builders, and it makes you wonder.
Yeah, I mean, the demand is certainly there because of the way that millennials are forming households right now and the way that we underbuilt here in the U.S. Yeah, geriatric millennial. Myself. Takes one to know one, okay? Yes. Come on. But I will say that, we didn't build homes here in the U.S. since the great financial crisis, and we're seeing the results of that right now.
Yeah.
KB Homes, Lennar, up next week, so key earnings for us to watch there. Meanwhile, I mean, interesting, of course, home builders so exposed to some of the supply chain headwinds. We all talked about lumber a while ago. Let's look at commodities for our radio audience. I'm looking at a slump of 6.5% for WTI crude. Brent crude off by more than 5%. You mentioned Exxon, of course, Tim. This is all as we see energy sort of play catch up to some of the words in terms of the focus of the Fed on driving down inflation. What does that mean in terms of recession risk? What does that mean, therefore, for demand? We're seeing oil having its worst day since March. Steel, metals also coming down. Interesting, iron ore on the lower side as we still worry about some of the lockdowns taking place in China. And I'm looking at natural gas down by 6% here in the US, but I mean up 50% in Europe, as we Romaine put it so eloquently, just the Russia supply issues, some of the major clients that they have being turned off that tap, and also then, of course, the exporting coming from LNG from the US to Europe being slowed down by that fire in Texas. So really painful what's happening in terms of the gas market. Also, what took us by surprise, come on, BOJ. We were so expecting after the bankers, the Swiss National Bank, after the Bank of England both hiked. No, they stand pat. They are still having those liquidity taps on. The yen weaker by more than 2% after we'd all giddied ourselves up that the BOJ might surprise too. We see, therefore, the dollar index once again reasserting itself, strengthening by 0.8%. That's why we see the Aussie dollar on the weaker side, the British pound weaker as well. And we see the Canadian dollar also down with oil. And, I mean, what a week for bonds worldwide. I look at Greek debt now rallying hard, similar for Spain, similar for Portugal. We used to call them the pigs. That kind of fell out of favor. But that peripheral debt doing well, Taylor, as maybe the ECB steadies some nerves. What about the US?
sort of the opposite picture here, Caroline, but I think what is so fascinating, we continue to be focused on the front end of the yield curve. You're up 7 basis points on the day, but you're only up 10 basis points on the week. Do not forget that you had 30 basis point move higher, then a 24 basis plunge lower, then 7 and 9 basis point swings in either direction on the other 2 days of the week. And so really, I mean, 7 basis points is calm, and that's pretty incredible given sort of the dampening of the volatility that we've had in the last few years.
And a lot of people keep talking about that calmness, but part of that calmness is the idea that a lot of people have kind of exited the building with regards to investors and at least some of the more short-term traders. So that can sort of create some of these more outsized moves, and that might not necessarily be a good thing as we try to work through whatever the next few weeks and months bring.
Okay, well, let's start with next week, a shortened trading week, as you guys mentioned. We do hear from Fed Chair Jay Powell. We've also got some economic data when it comes to home sales. And then, of course, we're also going to get consumer sentiment on Friday. So a lot to kind of dig into.
Yeah, it sounds like a new favorite of Jay Powell, right?
Yeah.
Hey, so that Fed move was the biggest since, what was the year?
1994. I've double-checked this. I've triple-checked this, Carol, after I sort of made the mistake on air. It doesn't really matter, though, right? 1994, 84, what's 10 years between friends? But you talk about sort of...
10 years in my age is a big difference.
10 years in my age. I was born in 1994.
They're both,
I mean,
I think both are millennials.
Member of this program. I would just like to point out, too, just real quickly, too, we talk about how that S&P went into bear round. I was just looking up the data because I was just curious about how short this bull market was, and it is going to go down as one of the shortest that we've had, and then compare that to how long bear markets last, which are typically, on average, about 1.5%. But you wonder if maybe the shortness of that bull market sort of shortens the duration, potentially, of the bear market as well.
Well, let's hope. Fingers crossed, and it depends how deep and long that recession is. You see how quickly
if we're in a recession.
Did you see how quickly Romaine got off of that mistake he made?
Deflection.
Wow.
Deflection. Yeah.
Oh, he was very humble.
I know.
On Wednesday.
I'm humble.
We
My
love
middle name is humble.
you. We love you, Romaine.
Yeah.
All right, we got to go. Have a great weekend, a long weekend, safe weekend, everyone.
Girl. Happy Juneteenth.
Yeah.
Happy Juneteenth. Think about what that means, everyone. All right, you're listening to Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
I'm exhausted. Big week. Lots going on in world and national news.
Let's go over to Denise Pellegrini in the newsroom here in New York. Hey, Denise.
Yeah, we're hearing from former Trump White House advisor Peter Navarro. He's pleaded not guilty to contempt of Congress charges. Navarro also introduced his new legal team to reporters after earlier representing himself.
I thought that we could handle this matter in a civilized way, dealing with constitutional issues. Obviously, being put in leg irons and having people want to put me in prison have changed matters.
And that's Navarro. He is refusing to provide documents for the House Select Committee investigating the January 6th insurrection, and he failed to appear for a deposition before them. His trial is scheduled for November. Advocates for President Biden's domestic agenda are reviving their pressure campaigns, and as Bloomberg's Nathan Hager reports, they have one big target in mind, and that is Joe Manchin.
Labor groups recently held a teletown hall in the Democrats' home state of West Virginia on expanding home care. Actress and West Virginia native Jennifer Garner recorded a robocall on the subject. And miners with black lung disease have launched a campaign called We're Counting on You, Joe, to extend the black lung excise tax on coal companies. Manchin has resumed negotiations with Senate Majority Leader Chuck Schumer on a reconciliation bill to pass the president's clean energy and health agenda with a simple majority. In Washington, I'm Nathan Hager, Bloomberg Radio.
All right, thank you, Nathan. And the White House says Florida doctors will be able to directly order COVID-19 vaccines for kids under 5 from the federal government. Florida Governor Ron DeSantis says his state will not order and distribute the shots. Final authorization from the CDC is expected shortly, and we're tracking it for you here on Bloomberg Radio. Global news 24 hours a day. I'm Denise Pellegrini. This is Bloomberg.
All right, how is it possible? First of all, thank you so much, Denise Pellegrini in our New York newsroom. How is it possible we haven't talked to Elon Musk and Tesla so far? How did that happen?
Yeah, maybe because I don't know, actually. That's a really good question. There are other stories, Carol.
I know.
But you know what?
But yes and no.
Between SpaceX and Tesla and Twitter and the Boring Company, and the list goes on, right?
Yeah, especially when you have quite an empire like Elon Musk does. What's interesting is this story, New York Times.
Yeah, Ryan Mack over the New York Times.
Big deal, right?
Yeah, he's been doing a lot of coverage when it comes to this. Also, some really good crypto coverage this week. I encourage everyone to check it out. In an email, Gwen Shotwell, SpaceX's president, said that this letter that we talked about yesterday on the program, Musk employees at SpaceX sending an open letter to SpaceX have been retaliated against. Shotwell saying that it made other employees, quote, feel uncomfortable, intimidated, and bullied.
Yeah, so a little backdrop, and again, I'm reading from the Times. SpaceX, of course, you know, the private rocket company, yesterday firing employees who helped write and distribute an open letter criticizing the behavior of Chief Executive Elon Musk. This, according to 3 employees with knowledge of the situation, again, from the New York Times. And some SpaceX employees began circulating that letter, which denounced Mr. Musk's activity on Twitter. That was on Wednesday, calling the billionaire's public behavior and tweeting, quote, a frequent source of distraction and embarrassment, and asked the company to rein him in. Mr. Musk is currently closing, of course, that $44 billion deal to buy Twitter. I am reading from the New York Times story.
We also got a Bloomberg story on this. The company had investigated and, quote, terminated a number of employees involved with the letter, Shotwell says in an email that was seen by the New York Times. This, again, SpaceX dismissing some employees who helped write and distribute an open letter criticizing the behavior of Elon Musk, citing 3 unidentified employees with knowledge of the situation, and this email from the president of SpaceX, Gwen Shotwell.
Did you mention this, or were we talking on our call?
Yeah, we were talking about it yesterday because I thought it was an important story to talk about in the context of Elon Musk addressing for the first time ever those employees at Twitter. And there's been a lot of pushback around that meeting that happened yesterday at Twitter, too.
And it's interesting because he seems to be a proponent for free speech, and yet
he's firing these employees.
It's tricky, guys, like the rest of the world. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Wall Street wraps up another losing week. On the week, the S&P was down 5.8%. It is down 10 in the last 11 weeks. S&P today up 8 points, little changed, up 0.2%. Late day fade for the Dow, down 38, down 0.1%. Nasdaq up 152, higher by 1.43%. 10-year yield 3.23%. Spot gold down 1.1%, 18.37 the ounce. West Texas Intermediate crude today down 6.7%, 109.69 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, earlier this week, I had the chance to sit down with Scott Baxter. He's the CEO of Contour Brands. They own Wrangler Jeans, Lee Jeans, and more. It's about a $1.8 billion company that back in 2019 was spun off from VF Corp. We had a great conversation. It touched on the supply chain, inflation, the possibility of a recession, and more. I started, though, by getting his thoughts on the macroeconomic environment. Check it out.
You know, it's been a big pendulum swing, right? So the pandemic has been really interesting. We're seeing the echoes of that. All of the pent-up demand that we had all came at one time. I think the thing that we're trying to think about is take a long-term view. So we're thinking about the stability of the consumer over time as they go from, you know, a really slow purchasing period at the beginning of the pandemic, and then that big ramp up here this last year, and then all of the stuff that's happened to drive up prices, right? So all the folks that needed additional trucking, you know, all the transitory, all the shipping, the delays at the ports, all of that kind of happened at one time. So now we're thinking that we're going to start moving into what we would call traditional buying patterns going forward.
How much have your prices had to go up as a result of all of those things that you just mentioned?
So we've had to do some select price increases, but we've been very strategic about it, you know, keeping the consumer in mind and doing everything that we can to run a really good business and make sure we keep our costs down too. So we've been very conscientious and very select in how we've done it.
How should investors think about it?
I think they should think about the fact that, you know, we run a really good business. We have a really sophisticated supply chain. One of the most important things at Contour Brands for us is we own almost 40% of our supply chain. As an apparel company, we're one of the very few, if one of the only, that has a significant piece of their supply chain in North America. We have plants in Mexico and Honduras. It allows us to control, you know, our supply chain. And if you think about that product doesn't have to hit the ocean. It doesn't have to go on a freighter, and it also doesn't have to go to the ports. It just gets made in South America and shipped right across the border to us.
To what extent has that put you at a competitive advantage against competitors who do actually make this stuff overseas?
Yeah, we think significant for a couple of reasons. Not maybe just what everybody else thinks, but we think it's strategic in the fact that, you know, as consumer tastes change, we have a much shorter lead time. So we can make things much quicker. You know, when you go overseas and you source, there's a much longer tail. So as tastes change, we can move quicker, we can get product in quicker, and we control our own destiny. So we control, and we're the only one in our own factories, right? So as you go overseas, you know, and you work with different factory partners, they might have multiple other vendors in their factories. Well, in our factories, as you can imagine, Wrangler and Lee are the only customers. So they get all of the attention.
Okay, speaking of consumer tastes, how are consumers doing?
You know, we think the consumer's doing pretty well. You know, there's a real shift to casual product as people come back to work. You know, we just came back to work about a month ago at our company, and people have either had to buy new clothes because they don't think their current clothes are fashionable enough, out of date the last couple of years. They've exercised a ton and lost some weight. Maybe they've actually gotten a little bit bigger. So there's multiple reasons that people have had to buy, but also it's become a casual trend, right? People are now coming back to the office and they're wearing denim, they're wearing casual pants, just a much different dress code. And that plays well for us.
What about the health of the consumer?
You know, we think from the categories that we play in. So remember, we're at a very nice price point. So you can buy a pair of our jeans for $17.99, and you can buy a pair of our jeans for $129.99. We run up and down the value chain. So we think that, you know, the higher end consumer is doing really well, and we offer a really compelling value at that mid-tier mass channel.
And do you expect the consumer to remain in good shape?
We think as we come through this, we think the consumer is going to be in really good shape. We think there's an opportunity for people to go back to work. We think that there's plenty of opportunity for people to get back out there as stimulus ends. There's been a lot of talk about stimulus, right? We think there's plenty of opportunity for employment as people come back off stimulus. And when they do, they'll be working. They're going to need apparel. They're going to need work clothes for that when they come out. So we think that could be a positive impact.
We've heard a lot of executives and a lot of analysts, too, being concerned about a recession in this year. Some analysts are even saying we're in one right now.
Yeah.
But some predicting we'll see one 2023, 2024. Where do you fall on this?
I actually have probably a little bit more optimistic of a view. I think that if we do, I think it's going to be short-lived. I think there's real strength in the consumer. I think there's a resiliency about the American consumer and about the American spirit that we're going to see. I think we're going to come through this. I think it's a difficult time right now, but I can feel something happening, with the American consumer and with America, that we're going to get this back on track in a pretty positive way.
Scott, I'm really interested in the conversations that you're having with your big customers right now. According to supply chain analysis on the Bloomberg terminal, 34% of your revenue comes from Walmart, Target about 5%. You see Amazon, you see Kohl's, Nordstrom in there as well. What are these large retailers saying to you right now?
We're a real big staple part of their business. So as you can imagine, apparel is extremely important to those folks. We've been partners with some of the names that you've mentioned for 30 to 40 years. So we're an integral part of their apparel pad. So right now, we're a really well thought of supplier. We have production for some of those folks in North America, which is really, great from a just-in-time standpoint. So we can be very turnkey for them. We're bringing new innovations to the product. We've introduced Lee to the mass channel in a pretty significant way, which has been a really big win for all of us. So we think our relationships are in a really good place as we continue to innovate and introduce new categories.
I want to end by just thinking about where you see the company going in terms of innovation in the next couple of years. What are you thinking about in terms of innovation when it comes not just to style, to brand, to marketing, but also to supply chain and figuring out a way to make sure that you are immune to future challenges here?
Well, I think that product is always going to be the thing that you have to drive everything with. When I've seen companies go off track, it's because they've gotten interested in a big acquisition that's not core, or they've done something where they've just kind of moved away from their product. If we stay focused on our product, stay focused on innovating, stay focused on our core, we have a big core business, we're going to be just fine. And that's where we spend an incredible amount of our time. Product, storytelling, channel and geography extensions. We introduced an outdoor line called All Terrain Gear, our work line. We just introduced a big t-shirt program for both of our brands, and we just brought Wrangler to China. So as you think about those things that are core to our strategy, if we continue to do those things, we're going to be in a really enviable place going forward.
That was Scott Baxter, the president and CEO at Kontoor Brands. It's the company that owns Wrangler, Lee Jeans, and more.
What a great perspective, and so important in terms of understanding supply chain and some of the issues out there.
Yeah, and the consumer, too.
This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening to Bloomberg Business Week. Carol Master, Tim Stanovic here in our Interactive Brokers studio at Bloomberg headquarters in New York City. We're going to talk about diversity. We're going to talk about investing. We've got a great guest coming up.
I love the title of the book.
Yeah.
I'm going to say it. Build the Damn Thing, How to Start a Successful Business If You're Not a Rich White Guy.
We're going to say it a lot over the next 30 minutes.
We're going to speak to Catherine Finney in just a few minutes. First, though, Charlie Pellet, how are things looking more than 30 minutes after the close?
It ended up being a mixed day. I mean, we had that late day fade, Tim, with the Dow dropping 38 points. Yes, swinging between gains and losses, but in the end, dropping by 0.1%. Perhaps the weekly number more interesting on the week. The S&P dropped 5.8%, down again. It has been down in 10 of the last 11 trading weeks. S&P today did hold on to an 8-point gain, up 0.2%. NASDAQ up 152, higher by 1.4%. Sentiment did improve as traders parsed comments from Fed officials who reiterated that the central bank needs to do more to curb the hottest inflation in 40 years. Well, as for the overall market backdrop, Larry Pitkowski is managing partner at Goodhaven Capital Management, and he was our guest right here on Bloomberg Business Week.
Being unlevered and having some cash allows you to control your own destiny and try and take advantage of the volatility that's going on out there, as opposed to the volatility taking advantage of you.
An antitrust lawsuit alleges T-Mobile's 2020 acquisition of Sprint Corp reduced competition and led to higher prices for all U.S. mobile phone customers. And GM is boosting Hummer prices, joining the parade of EV makers that are charging buyers more to make up for inflation in the commodities and materials needed for production. GM up today by 1.5%. 10-year yield 3.22%. Spot gold down 0.9%, 18.40 the ounce. West Texas Intermediate crude down 6.4%, 110.04 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Well, earlier this month, Bloomberg was out with a story about the bulk of U.S. venture investors and how they want to back minority-run firms and similarly invest in businesses founded by women. The data is coming from the private equity firm Color Capital, and our next guest definitely has some thoughts on this.
Yeah, really eager to chat with Catherine Finney. She's founder and a CEO at Genius Guild. Genius Guild is a VC fund, also a studio. Catherine joins us via Zoom from Chicago. She's also the author of the great book, Build the Damn Thing, How to Start a Successful Business If You're Not a Rich White Guy. Catherine, good to have you with us.
It's great to be with you all.
We love the title.
Yeah, we do.
First
we love
of all.
Thank you.
Well, can you talk a little bit about the title and coming up with something like that? Because it certainly catches people.
Yeah, the title is what I say often when I meet with entrepreneurs. So kind of being out in, the talking conference circuit, I would often get entrepreneurs coming to me pitching. And they would give these great ideas and, really well thought out ideas. And I would ask, well, let me see a demo. Do you have something on your phone I could see? And they would say, oh, well, I haven't quite built it yet. And they would go into all these reasons why they didn't. And I would say, well, just build the damn thing. Like, what are you waiting for?
But that's like what venture capitalists always, or that's what I should say, founders always say needs to happen, right? You need to have this minimal viable product in order to build on it and iterate, right?
Yes. You have to start off with something in order to get feedback. And actually in building your minimal viable product, which is really the simplest version of your product that you can build to be able to put out into market or to show to people to get feedback, it allows you to get information, get thoughts, get feedback before spending too much money in building your product. And that's very, very important. Oftentimes founders, particularly founders who come from communities that are outside of traditional communities in the startups, will spend tons and tons of money, tap into their 401k to build these robust prototypes without knowing whether or not there's a market for it. And it really goes back to this concept of product market fit. Does your product have a market? Does your product have people who want to pay for it? And so your goal with your minimal viable product is to find out this product market fit without spending a ton of money.
You know, it's interesting. What I love also about this book, and I feel like this mirrors some of the conversations Tim and I were just back from Dallas, Texas, at the Insight 2022 conference, talking with financial professionals. But diversity and inclusion came up big time. And one of our chats specifically was about how you have to have diverse investment advisors to reach out to the diverse investment public that is out there who are increasingly being left behind. Talk to us about that when, you know, in terms of businesses that are being left behind and markets that are being left behind because we're not tapping into a more diverse consumer marketplace and not supporting diverse entrepreneurs who see the need for that.
Yeah. I mean, you're leaving money on the table, right? 1 in 4 new entrepreneurs are Latino. Black women are one of the fastest growing groups of entrepreneurs. You are leaving money on the table when you're not reaching out to these markets. This is the new future. And so it's really important to be able to understand how to reach these markets and in the world of startups, how to work with these startups coming from these markets, mostly because these startups are tapping into new areas and new opportunities for growth that you may not be able to access or even understand if you're not part of those communities. So by investing in them and by getting to know these amazing founders, you're actually giving yourself more diversification within your own portfolio.
All right, I want to be provocative because I love that you lay it out there. And thanks to kind of sharing some materials with us. You talk about arming readers with responses to investors who have told her, quote, great pitch, but I just don't do Black women. I mean, that happens. That's a reality, right?
It happened to me.
Well, tell us. All right, so tell us about that.
Well, I think, you know, and it's been well documented in venture capital about the pattern matching, right? Of this idea of, because every successful founder I've invested in was, you know, a 25-year-old white guy from Stanford. That means that every successful founder is going to be a 25-year-old white guy from Stanford. What is interesting about that is the inherent fallacy, which is it also means that all your failed investments also came from 25-year-old white guys from Stanford. And so what happens is when someone like myself or a woman or a diverse entrepreneur shows up, it's kind of like, you know, this anomaly, like, oh my gosh, you're here. And so we often find, you know, in the hour meeting we get with a potential investor, that 45 minutes of that is just explaining how we got into the door. They're so fascinated about us and our history that we only get about 15 minutes to actually talk about our business, which is what we're there to talk about. And so it becomes really hard to be able to pitch when people don't see you as a business or they completely don't understand the business opportunity. And no matter what you say, no matter what type of data you have, your metrics, the total addressable market, you know, all those great things that, you know, investors say they love to hear, they don't hear it because they're so sort of distracted by you and your presence. And so, and that definitely happens. I think as a diverse entrepreneur, though, the goal is always to redirect, right?
Right. Hey, hang on for a second. We got to do a little bit of news, but we're going to come back and continue with Catherine Finney. She's founder and chief executive officer of Genius Guild. We're talking about her book, love the title, Build the Damn Thing, How to Start a Successful Business If You're Not a Rich White Guy.
Let's go to Denise Pellegrini with world and national news here in New York. Hey, Denise.
Hey there, and we've got breaking news for you. President Biden, the White House and congressional Democrats, they're in advanced talks, according to a source, on legislation that aims to fight inflation, rein in the deficit, and revive parts of President Biden's stalled economic agenda. And we'll be tracking developments on that for you here on Bloomberg Radio. Dozens of COVID vaccines for kids under the age of 5 could be shipped out Monday. The White House says they could be in arms as early as Tuesday. FDA Commissioner Dr. Robert Califf.
We expect that the vaccines for younger children will provide protection for the most severe outcomes of COVID-19, such as hospitalization and death.
And final CDC approval expected shortly. President Biden blaming oil companies for those sky-high gas prices at the pump. He says that the industry holds drill leases, but they're not acting on them.
They have over 9,000 leases. 9,000.
And Biden commenting on his way to Delaware. Former President Donald Trump attacking the House Select Committee's public hearings into the January 6th insurrection.
Let's be clear, this is not a congressional investigation, this horrible situation that's wasting everyone's time. This is a theatrical production of partisan political fiction that's getting these terrible, terrible ratings, and they're going crazy. They're going crazy.
And Trump speaking in a Road to Majority policy conference in Nashville. And Steve Bannon asking a federal judge to exclude evidence related to the January 6th storming of the Capitol. Longtime Trump advisor has been indicted for contempt because he's refusing to comply with the committee. He says the evidence should be excluded because it would prejudice a jury. Global News 24 hours a day. I'm Denise Pellegrini. This is Bloomberg.
All right, Denise, thank you so much. Carol Massar, Tim Stanovic, we're live in our Bloomberg Interactive Broker studio, streaming on YouTube. We want to get to something that Denise mentioned, a headline, and our story that just crossed the Bloomberg by our Jennifer Jacobs and Josh Wingrove. The White House and congressional Democrats are in advanced talks on legislation that aims to fight inflation, rein in the deficit, and revive parts of President Joe Biden's stalled economic agenda.
The contours of a potential deal, our colleagues write, remain under negotiation, but the package would likely include capping the price of insulin, a key medicine for diabetics, and federal investments in both clean energy and fossil fuels, according to people briefed on the talks. It would also further reduce the budget deficit and boost taxes on the wealthy. Corporations or both. They said, interesting here, Carol, federal investments in both clean energy and fossil fuels.
Well, this is part of his broader agenda. I feel like it's interesting
But the fossil fuels element is really important here.
Well, that's true, right? But isn't that the reality of where we are, right?
Yes, it's the reality of where we are, but that's not where the most progressive wing of the Democratic Party wants to be.
No, right. And this is, some would say, come on, right now you've got to look at what's facing the economy at this point. It's interesting. I feel like it's a bunch of things that could play or improve his chances come re-election time. And I think about insulin and diabetics. There's a lot out there, certainly in the U.S. population. A lot tend to be an older voting population. Older citizens tend to vote. So it's interesting to see how it's laying out.
An agreement could come together as soon as next week, the two people said, though others were more cautious, noting many details remain to be resolved. Climate provisions are a particularly tricky area, and differences could still scotch a deal, one person said.
Democrats desperate for a policy response to inflation, which is at a 4-decade high and unless curbed, is all but certain to cost them control of the House, Senate, or both in November's midterm elections. We know gasoline, a critical component of the American household budget, costs $5 a gallon on average nationwide, according to the AAA Motor Club, hit a record earlier this month. I mean, we talked about it, right? About inflation and what it could mean for a second term for President Biden. This story, again, just crossing.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pelletas. We've been reporting the White House and congressional Democrats are in advanced talks on legislation that aims to fight inflation, rein in the deficit, and revive parts of President Biden's stalled economic agenda. Turned out to be a mixed Friday, definitely a losing week. This week, by the way, the S&P was down 5.8%. Today, it did hold on to an 8-point gain. Choppy session up 0.2%. The Dow, though, late day fade down 38, dropped today of 0.1%. NASDAQ up 152, up by 1.4%. 10-year yield 3.23%. Spot gold down $16 the ounce to $18.41, down by 0.9%. Bitcoin 20,617. Bitcoin down now by 0.3%. Spot gold down $16, as I mentioned, down 0.9. West Texas Intermediate crude, big drop there, down 6.5%, 109.95 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. I want to get right back to our guest, Catherine Finney. She's founder and CEO of Genius Guild. It's a venture capital firm, and she joins us once again via Zoom from Chicago. Catherine, I want to get to Chicago here and talk a little bit about venture capital in Chicago, because when we think about VC, it's so often in the context of California. And you mentioned the 25-year-old white guy Stanford grad as being sort of the archetypal tech founder. Or we talk about it in the context of New York. Would you say that venture capitalists who are isolated to those areas of the country miss out by not being in Chicago?
You miss out on new opportunities and new markets, right? And there's a lot of VC firms now that are starting to pay attention, not just Genius Guild and what we're doing here, but also, Steve Case and Revolution and Rise of the Rest has been for several years going around sort of middle America outside of the coast and investing heavily in amazing startups in these sort of places. And so there's a lot of opportunities, a lot of great companies that are coming out. Companies are really solving some interesting challenges. There's a lot of cyber tech companies here who are, particularly in Chicago, who are solving cyber solutions.
Interesting.
There's a number of companies around food and the future of food that are also in sort of the Midwest region, which is also very interesting. It kind of makes sense because we're the breadbasket of America, but so there's a lot of emerging opportunities here that I think people tend to overlook because, again, we're in the middle of America and sort of people are not coming here to see, but I welcome everyone to come to Chicago and see what we have here.
Where are the founders that you invest in, or at least that are pitching to you? Because you're not, of course, investing in every founder that's pitching to you. What are their backgrounds typically? And are they coming out of school, university? Are they coming from established firms? What's a typical startup founder who's looking for funding from you?
Yeah, and so our founders have really strong domain knowledge and experience in what they're building. So one of their companies, Health and Her Hue, is kind of WebMD for Black women, and it's experienced enormous growth over the past couple of years. It was founded by a Black woman with a public health degree, who also happens to be what I have too, which is a public health degree as an epidemiologist. We have founders who have working in the creator economy, who also were creators themselves or worked in the agency side, so they have experience working with creators and understanding the opportunities there. We have companies that are working in supplier diversity chains in the supply chain and diversifying that, who have tons of experience working in the supply chain. We also have invested in a couple of other funds as well that also are led by general partners who have experience either in the sectors that they're investing in and or coming from really top-notch venture funds.
I have to first ask you, what is it about Voldemort today? Because Tim O'Brien of our team, our opinion team, has tweeted out a picture of him in connection with pardoning. And then I love in your book that says you've gone from standing up to the Voldemorts of venture capital to leading your own multi-million-dollar fund. I just love it. It was that bad? That's pretty hard. Anybody who's watched Harry Potter and been terrified by the evil villain, Voldemort, that's terrible.
It was that bad. And I talk about in the book what it was like in the early 2000s. And I think some of us kind of forget because it was so long ago.
Yeah.
But there really was not very many women, and definitely not very many women of color. And so it was this atmosphere where people didn't have just low expectations. They had no expectations of me. And being a lifelong overachiever, that was incredibly difficult for me to be in a situation where people didn't think I just couldn't do it. And so I had to develop tools and I had to develop ways in which to get around that. And a lot of those ways I share in the book.
I love it. You do. It's really great how to and really walking people through all of the processes or procedures to build their own successful business. It's interesting too, in venture capital, and like you said, this isn't a news story. We've written about it a lot at Bloomberg, but even like women venture capitalists not investing in women-led companies. And I find it funny because we just talked with Tory Burch, Embrace Ambition. She had a big summit this week, but she also has been about specifically, providing money for female entrepreneurs. And what is it about, though, that women in Silicon Valley weren't backing other women? Was it just the pressure of the firm?
Well, there's almost a tax that you pay. So if you're a woman investor and you invest in women, there's almost like a tax that you pay that perhaps you're not able to spot great investments, right? With the understanding being that women are not great investments, right? And so it's almost a tax that is for any VC who falls outside of the norm, that if you tend to over-index your investments in whatever group that you identify with, that somehow you're creating favoritism, somehow you're not investing in them because you see opportunities, that you're somehow not as great of an investor. And that's actually documented. There's been research that's come out. There's a penalty not only for the VC, but there's also a penalty that's paid for female founders who raise for a significant amount of their rounds from female investors. And so that penalty is true. And that causes marginalized investors to sometimes not invest as much as they would in the groups that they understand and the markets that they understand.
All right, great book, as we said, great title. So, all right, we just have a few seconds left here. If you had one piece of advice for someone who wants to start a successful business, what's the first thing that they've got to do?
Build it and get it out there, test it, take the feedback, and build it again.
All right. Well, listen, this has been so much fun. Stay in touch. Love to hear more, too, about your VC investing going forward. Always to hear about kind of where you're going. Catherine Finney, founder and chief executive officer of Genius Guild. She is a VC investor. She's built her own business, and now she's sharing what she's learned with others. It's all in her book, Build the Damn Thing, How to Start a Successful Business If You Are Not a Rich White Guy.
Great title.
Yeah, great title, and great, very, advice, laying it out for, other people who are looking to start their business, women, people of color, minorities, just trying to figure it out. Speaking of figuring it out, we all have a lot of questions about what the outlook is, although we did get some certainty about we're going to have a pretty aggressive Fed going forward.
Yeah, certainly in the short term at least, right? Thinking about front-loading those rate hikes. 75 basis points is the new 50. I think it's fair to say that we learned
40 is
this
the new
week.
30 on the VIX.
Oh, you got it. Hey, look, you're right, though, recalibration.
It's been my watchword because I just think most of us, nobody has lived really through a pandemic before, and the market coming undone and then bouncing back so quickly. I thought it was interesting what Romain said earlier about that if we do have a recession, it's the potential, right, for it to be kind of a quick move, maybe. Yeah. And so, right, he did say that, right? About a recession specifically.
Well, because he said the last bear market we had was so short. The last bull market we had was so short.
I mean, the cycle that we've been living through is unlike any we've seen before, and so there's lots of questions. We really don't know what the other side is like, especially when you have global central banks who all put out tons of punch bowls for all of us, and now it's like the party's over, kids, go home. I'm ready to go home because I need a nap.
I am too. I'm hungry also.
Listen, if you're stuck in an airport, stranded somewhere, we do hope you get home safely. And in the meantime, don't forget to check out our weekend podcast and broadcast. For Tim Stanovic, I'm Carol Massar. Have a good and safe evening. This is Bloomberg.